Good morning, everyone.
Good morning.
That's better. Karibuni sana. Welcome. Today, you're students. We want you to learn, and we want you to leave out of here with good information that can help your scheme grow, your pension scheme. Thank you so much for coming. I've seen a number of trustees in the house. Karibuni sana. The fund managers in the house, welcome and thank you for honoring the invite. And also we have the pension administrators. Thank you for coming. So we'll start off the program, and straight on I'll invite Ngatia Kirungie, our head of Secretariat at KEPFIC, to do an opening remark and introduce KEPFIC, and also tell you why we are all of us here today. Karibu sana Ngatia.
Good morning, ladies and gentlemen. Thank you for being with us today. We have really been looking forward to having you here. The Everstrong team will tell you that we have been working together for the past probably more than 2 years, as they were thinking about how to best approach the local institutional investor community. And we are very, very proud to be working with them to have this day as the first of many engagements with a lot of you in the room, whether you are the fund managers, the trustees, or the administrators. So once more, karibu sana. I'll just take you very briefly through the program for the day. So after I make my very brief opening remarks, I'll take you through a little bit about KEPFIC. That one is mandatory. I'm sure a lot of you have heard about KEPFIC before, you know all about us, but we think it's important that just to give it context on why we are here in this room, and largely to talk about why pension schemes should be investing into alternative assets such as infrastructure, and also the how. So I think we have talked very many times about why infrastructure is important, and I'll take you through that. But also there are various modes of getting that kind of infrastructure exposure. Then we will move straight into the Everstrong team's presentation, where they will present their Kenya fund to us. Henry Kyanda and Pumla Mathe will talk about their strategy. We'll also hear about the fund structure from their lawyers, Romans, as well as the pipeline. Now this is really important because, as you will hear, Everstrong have already closed their first transaction, and so we'll get to hear not just about that transaction, but also how do they think about the opportunities that they see in the country ahead of them, in front of them. So we will hear about the investment process, about a case study, and finally we'll hear from our independent advisors, the World Bank and USAID, on their thoughts around investing through infrastructure funds. Before we have closing remarks, and then we have lunch. So this is not going to be a very long session, and so without further ado, let me take you through the first bits of the day. So I'd like to start off with this slide, and this slide essentially just gives you a sense of the amount of interest in Kenya's infrastructure development through PPPs. And as you can see, in front of you, these are some of the 3 largest transactions that have been either broken ground or have been announced recently. So you have the expressway right next door to us, about to be opened, about, I think it's about 60 billion shillings. We have the Nairobi-Mombasa road proposed, about $3 to $4 billion, I think closer to 4 billion at last discussions. And you have the Mau Summit Road, 160 billion shillings. Now, there's often a misconception that these are government-to-government transactions, when in reality they are PPPs. And the PPP essentially means that there is a private sector player who has teamed up with government, and usually the private sector player is bringing in the financing, the development expertise, the operational expertise, and government, in our case, provides all the approvals, provides the land, provides the enabling environment to allow these private sector players to invest and to get healthy returns. Now, those private sector players are often pension schemes. In fact, not often. Majority of the times are pension schemes. So you can see here, you have some of them. You have some firms like Meridian, you have Bechtel, you have CRBC. And what they have done is they have mobilized resources and capital from their home nations, from their home pension schemes, as well as from global pension schemes, to invest in Kenya's infrastructure. And the reason why they would do that is simple. It's because Kenyan infrastructure investments are very lucrative. So these pension schemes that they have tapped include some of the largest investors in the world. I won't name all of them, but you can. So these names should be very familiar to a lot of the investment community here. But there's one thing that strikes us all when we look at this slide. We don't see any local pension schemes. And that's surprising, because in just about every other jurisdiction, the infrastructure of that nation is held by local capital, by long-term holders of capital like pension schemes, insurance companies, and the likes. But in our case, we hardly see any local participation. But if we take a step back, so why are these international pension schemes so keen on infrastructure? And why is infrastructure a viable investment category for your portfolios? Can be summed up really in 3 or 4 points. The first is the returns. I've mentioned the returns. If the returns weren't competitive, we wouldn't be having this discussion. Everstrong would not have gone through, the years of strategy and the years of building up the pipeline as they have done. But secondly, diversification. Right now in our market, local pension schemes are in dire need of greater investment opportunities than just Safaricom and government bonds. So having the option of investing in a road project, a power project, whether directly or through funds, would provide a great opportunity for diversification of your portfolios. Then pension schemes are long-term holders of capital that have long-term liabilities that need to be matched with long-term assets. So infrastructure opportunities are long-term in their very nature, and so fit very well with the liability profile of their own liability profile. As their members retire and require regular payouts in the next 20, 30 years, you will be able to get the cash flow for those investments, for those payouts through these long-term investments. And finally, when you're thinking about any long-term investment, what's one of your biggest fears? Inflation. So you can buy a government bond today that is 18, 20 years, paying you 13, 14%, but that's before inflation. If inflation is 7% and the bond is giving you 14%, your net return is really 7. What happens if inflation goes to 10 or if it goes to 11? It means your return keeps going lower and lower and lower and can ultimately end up being negative. So one of the most critical parts of infrastructure investments is that their returns are often linked to inflation. So if inflation starts to rise, your returns will rise with inflation, and so your net return remains the same. So your 14 or 11% stays at 11% regardless of the macroeconomic environment. That's a feature that government bonds do not give you. Yeah, we don't have inflation-linked bonds in this market. So you have to find another way to protect yourself against inflation. And infrastructure is a very ideal asset class for that. So, what is the need? We keep hearing about this funding gap. And in front of you, I can tell you, we have very conservative numbers. In fact, we made this presentation to the Ministry of Transport, Infrastructure, Housing and Urban Development the other day. And the first thing they said is, the deficit is not $2.1 billion every year. The deficit is closer to 4. So it tells you that there is, if you look at Africa as a whole, 70 billion is required every year. In Kenya, we need at least $3 billion every year to meet our development goals. But so far, the funders of this infrastructure has been government. Yeah, no surprise, and that's not just in Kenya, that's all across the continent, you can see African governments comprise of at least 38%, 37.2% of the sources of infrastructure funding. But these governments right now are facing competing priorities. Yeah, number one, we have healthcare with COVID. You have the economic recovery that is required from that. You have other competing priorities such as education and SMEs and the likes. But also, there's also concern about growing budget deficits, increased debt. We keep hearing that in our country. And so it means that African governments have to take a step back. And when they take a step back, it leaves a great opportunity for the private sector to take a step forward. Private sector, as you can see, accounts for less than 12%. In Africa, that's low globally. This is probably closer to 30%. Yeah? So there's a great opportunity for private sector investors to participate in infrastructure development. And like I showed you, there's a very good reason to do that, beyond just it being a good thing. Infrastructure is one of the few opportunities where you can actually have social impact, where you can have impact plus returns. So on the macro scale, you can see why it is important for us to participate, and it is really to our benefit. When we think locally, this chart shows you the growth of the pension fund industry over the years. And you can see it's rising steadily to the right, about 1.4 trillion shillings right now, 16% of GDP. And according to regulations, pension schemes can now invest up to 10% of their assets into this asset category called infrastructure. This wasn't the case before. And that caused a lot of uncertainty around if I'm a pension scheme, can I really invest in a power project? And so what you'd find, it's only the pension schemes whose sponsors or whose parents were in infrastructure that were participating. A good example is Kendall and Kenya Power. Their pension schemes were investing in power plants. But if you ask a bank pension scheme, they would be, who could just be as large, they would be uncertain. So regulations are really in our favor. And you can see there, it's not just the 10% I mentioned, but you can also get exposure to infrastructure with another allocation through private equity and venture capital, another 10%. So I think this is a good place to start talking about actually why we're here in this room. So I mentioned that you can invest 10% directly. There are some challenges to that. It's a very heavy lift, I can tell you. We recently, as KEPFIC, we marshaled our membership together to look at a road bond the other day. And it was very successful. We were looking for 2 billion shillings, and we managed to raise about 5.1 billion. That's good, but it took us over a year to get there. Yeah? And so, whereas that's one method of getting exposure, can also be very difficult and inefficient. So you have the option of going direct with the second 10% you see at the bottom there, that instrument, or utilizing the expertise of third-party fund managers, for example, Everstrong. So if all of that is true, why aren't we seeing local pension schemes participating? These are the 4 reasons that we kept hearing about as we go talk to the market. The first is that those limited awareness of these opportunities, and that's no one's fault. I mean, it's not very often that someone who's looking to build a road or build a power plant will go knocking on the doors of the pension schemes. Pension schemes just have not been known as the providers of capital for infrastructure investments up until now. But even if they were aware, internally, both at the pension scheme and at the service providers, there is limited investment expertise to be able to assess these opportunities when they come to them. I think we can all understand how bonds work. We can all understand how when you invest in Safaricom, you're waiting for the dividend, and the dividend is a result of the performance of the company. And we're probably all invested in stocks before. but very few people have actually invested in a road project, for example. So that investment expertise is lacking. And then the size of the opportunities is very, very large. You saw the numbers in the first slide. It's too large for one pension scheme to undertake a road project that's going to cost 160 billion shillings. Way too large. And so what that does is that it's actually a hurdle. The size of these opportunities is a hurdle for a lot of the pension schemes here locally because of our size. Globally, we have some of the largest pension schemes out there that are looking at Kenya, and so they can take these large exposures. But locally, we're still conservative and we're relatively small. So the size of the investment opportunities was a hurdle. And lastly, there was regulatory uncertainty, and I mentioned this. This is no one wants to fall foul of the regulator, and so everyone's first thought is, what does RBA really think about me investing into a road project? Yeah, will I fall foul of any of the rules? Will I be, in trouble? And so I'm glad that that regulatory uncertainty part has been resolved. But for everything else, that's the reason why KEPFIC was formed. So we are in existence really to help pension schemes tackle those 4 challenges. The first is to bring investment expertise to the table, and that's to really build the capacity of our membership. So this is where I need to be clear. So KEPFIC is not a fund manager. We are an association of pension schemes that have come together to jointly assess and invest in infrastructure opportunities. So one of our first priorities is to get everyone in this room and to get your stakeholders as comfortable with how a power plant or any other infrastructure opportunity works as you are with stocks and bonds. So to bring that investment expertise to the table. Also to bring a robust deal pipeline. And that's not just direct opportunities for you to review and to invest in, but also to bring you the managers that are the experts in infrastructure investments, and for you to take a look at them and their strategy, which is why we're here today. I mentioned the size of the opportunities being problematic. Well, not if we pool together. The exact saying, you can go a lot further together than you can alone. Well, this is very true when it comes to the size of these infrastructure opportunities. So instead of one pension scheme looking to invest $100 million, why not have 10 pension schemes, each putting in 10? Yeah, so pooling resources is very powerful. As we know, we are conservative right now, and this is very new to us. KEPFIC is always working on ways to improve the risk profile of these opportunities by putting in elements such as investment guarantees and also liquidity. We know that one of the number 1 questions we hear from trustees is, we don't want to be stuck with something for 20 years and be unable to exit it and end up in the same position we are with property. So as KEPFIC, we try and advise these project sponsors to structure their opportunities through liquid instruments like bonds that can be traded in and out. And finally, I mentioned regulatory certainty. So in September 2020, KEPFIC sat down with the National Treasury, we sat down with the RBA, and we are the ones who pushed for this new asset category of infrastructure to be introduced. So we were launched officially in October 2020, and at the time we had some pretty high-level speakers at the day, some who are here with us today. We had Mr. Kyle Makata, who was the US ambassador to Kenya at the time, and who is in this room. We had Dr. Julius Muya, the PS National Treasury, and we had the CEO of the RBA, Mr. Nzomo Mtuku. And if you haven't already, please take a look at our website for the launch highlights. Our partners include the World Bank, USAID, and MiDA advisors. And I just want to highlight that this initiative of bringing pension schemes together to look at infrastructure has been recognized as something to be replicated across the rest of the continent. So you will find that pension schemes in Southern Africa and in West Africa are actually looking to us as a demonstration of what they themselves can do, because they also face the same challenges that we are here. Yeah? So after our launch, we looked at, we engaged with the market, trying to bring to the table some viable opportunities for you to look at. Because we do believe that, yes, we want the market to gain expertise, but there's no better way of doing that than looking at a real live opportunity. So we reviewed over 17 transactions, and that's closer now to maybe 30. We shortlisted 5 deals, and one of those deals was the road project that I mentioned. So in summary, they were looking for 2 billion shillings. This is a road under the road annuity program. It's a road in northern Kenya, so an area that is, would be considered marginalized, an area that, and in an investment that people would always wonder, like, so, but how would we be paid for a road in northern Kenya? We managed to get a guarantee from Garantco, 100%, irrevocable and on demand for both principal and interest, which means, unlike, say, insurance, where if something goes wrong, you have to claim, you have to prove the loss and then claim and the likes. In this case, if anything went wrong, and it doesn't even have to go wrong. If payments are late, you simply would be paid by Garantco 100%. You can see we were looking for 2, we got almost 3 times that. Yeah? This is testament that there is appetite from the local investor community for this type of risk. Before, it was unclear. Now we have proof. Yeah, so even if you just use the $30 or so million that we were not able to absorb from this project, it tells us that we can bring more opportunities of a similar risk profile, and the pension schemes are willing to listen and are very interested in learning more about this. But that was an example of direct investment. There's also a way to get the same exposure through infrastructure funds. And as you can see, this is a typical structure of just about any fund, not just infrastructure funds, where you have your limited partners at the top, investor A, B, and C. In this case, it would be pension scheme A, B, and C, that invest in a fund that is managed by a fund manager, the general partner. And then that fund manager really invests either debt or equity into various opportunities, various projects. And I'm sure when we hear from Bowmans, it's going to be a similar thing for the Everstrong fund. And so what are the positives of going through a fund rather than directly? I mentioned that directly it's quite a heavy lift, but let's focus on the positives of the fund approach. So returns, whether it's direct or through a fund, are good. So let's skip that. Diversification. Now, the fund route offers a second level of diversification. So first, you invest in a fund, and the fund manager invests in a portfolio of assets, not just a single asset. Then you can further diversify by investing in multiple funds. So you have 2 levels of diversification there, which is very, very important. Then there's also the accessibility and relying on the specialized teams. The reliance on the specialized teams that these infrastructure fund managers have in-house. So you no longer need to think about building your own expertise to become an expert in how this will work or how that road project will work and the likes. There's a reason why you tap into the multi-decade experience of some of these fund managers. Yeah? And it's both global and Pan-African, really important. And finally, alignment of interests. So the fund managers typically invest alongside you as investors. So you are aligned in the economics. The fund does well, they do well, you do well, everyone is happy. So the risks are you all view risk from the same perspective. It's very, very critical. So it's my last slide. So what we have done as KEPFIC is we have reviewed a number of funds that we wish to bring to our membership. You can see Everstrong is one of them. There are a number of others. Some of them are not infrastructure focused exclusively. Some are in housing, some are dedicated to renewable energy, some are more general. But this just goes to show that we want to be able to take to our membership the various options that they can invest and participate in our own infrastructure development. So, lastly, let's talk about joining KEPFIC for those who haven't or those who are not aware. You can see these are the benefits. We provide access to pre-screened alternative investment opportunities. We would have the one-on-one engagements with yourselves and the Board of Trustees and investment committees on each of the opportunities. We're always looking to have preferential investment terms, and in a few cases we have actually secured that. You'd be pooling your funds with like-minded investors. You'd be able to share in the cost of some of the due diligence. So as an example, it might cost you $100,000 to get a technical advisor, legal advisor, tax advisor for a single project. And that can still lead to, that's no guarantee that you'll invest in the project. But if we share in that cost, then it's a little less painful for us to look at multiple opportunities together. I mentioned the independent assessments. You'll see one this morning from the World Bank and from USAID. And then, it's not that KEPFIC is one way. We're not just bringing investments to you. We also know that some of these pension schemes in this room have alternative investments, primarily in property, that don't want to show to the rest of the market to help with exit. Yeah, so that's an opportunity that being a KEPFIC member brings to you. Local and international capacity building seminars and workshops. There's one we're planning a workshop in Chicago in June this year, which we shall be sharing with our membership, where you'll be able to engage with US and Canadian pension schemes at a conference there. Collaboration and networking. Yeah, it's really important that we learn from each other more than you learn from me standing up here to tell you why infrastructure is good. It's better when you hear from a fellow trustee that we invested in this project and this is what it has done to our portfolio. Yeah, that's very critical. Representation and advocacy with the regulators and other stakeholders, and obviously access to research and resources to keep you up to speed with what's happening in the market or in the industry. So membership fees are very simple. So there's a one-time administration registration fee of $25,000, and then annual subscriptions. I mentioned we are an association like any other, so subscriptions are normal, but we have tiered our subscription fees essentially, where the largest schemes, those who have assets over 2.5 billion, pay $150,000 a year. And the smaller schemes, those below 1 billion, pay $50,000. And that's so that we can have as many pension schemes as possible, including the small schemes, as members of KEPFIC. Remember, the challenges of the big schemes are no different than the challenges of the small schemes. If anything, the smaller schemes probably need greater diversification, because with the limited amount of capital they have, if they are very concentrated into one stock, for example, or a few stocks, they're in a very precarious position. So trying to make sure that the doors are open to the largest and the smallest schemes in our market, both public and private pension schemes. So I'll stop there and invite, I'll stop there and invite Mercy to come back and take us to the next part of the agenda. Thank you very much.
Thank you so much, Ngatia. I know at the end of this we'll have many questions. So what I'm going to request is, as we do the presentation, you have a notebook and a pen. You just draft your questions so that you make sure by the end of our session today we're able to answer all your questions. So from every presentation, just write your question and then we'll try to handle them as they come, and those that will require different presenters to respond, then we will have a Q&A session where we'll have that opportunity to receive the responses. Next on stage is, we'll welcome Henry and Pumla from Everstrong so that they can take us through Everstrong Capital and the Everstrong Infrastructure Fund. And I'll invite Pumla so that She'll be the one to introduce and welcome Kyanda. Pumla.
Good morning, everyone. My name is Pumla Mathe. We'd like to thank you for the opportunity today to discuss the Everstrong Kenya Infrastructure Fund. I'll be basically just walking you through the fund strategy. We'll also be talking through Everstrong as a team. We'll also be discussing our impact on our investments. Most of the people around the room have an idea who and what Everstrong Capital is, but for the sake of those who are not familiar with us, so we are a U.S. infrastructure investment firm. We are U.S. SEC regulated. We have offices in the U.S., in Kenya and South Africa. Our focus sectors include energy, ICT, transportation, water, and social infrastructure. So in social infrastructure, we invest in housing and healthcare infrastructure. In the energy space, we would look at power generation, power transmission, power distribution infrastructure, as well as LNG and midstream gas infrastructure. In the ICT space, we would look at broadband, cell towers, as well as data centers. In the transportation sector, we invest in ports, airports. We would look also at rail networks and toll roads. In the housing sector, we look at affordable and sustainable housing. And in the healthcare sector, we would look at lease of medical equipment, as well as lab and diagnostic imaging equipment. Our fund strategy is to invest in essential assets. So we invest only in equity. We do not invest in debt. We invest in essential assets which have a long-term predictable cash flow. And we'll only invest in brownfield. We'll only invest in operating assets. So Everstrong Capital is sponsoring a $50 million Everstrong Kenya Infrastructure Fund, which invests in Kenya as well as East Africa. We're also we'll be marketing a $500 million infrastructure fund, but we'll only resume that fund in early 2020. So one question we get often when we are presenting the fund is why Everstrong? What makes us different from most PE funds or infrastructure investment firms? So we are a diverse team, and I'll take you through the team. We are quite a diverse team. We come from different countries, and we bring those relationships and those networks into the team, but more importantly, we have a proven track record, right? So we have a track record in structuring and implementing infrastructure investments, and we also, so we bring in the track record, and we also a diverse team. We also have the backing, the founding partner, Mr. Phil Dyke, who will introduce himself. He brings in over 30 years experience in financing infrastructure. He was the founding partner of Alinda Capital, which is one of the largest privately owned infrastructure investment firms. And Alinda Capital had over $10 billion assets under management in 2017. So we bring relevant experience in structuring and executing infrastructure deals. Collectively, our team brings over 150 years of investments in infrastructure and a combined investment portfolio of over $20 billion. One other differentiating factor of Everstrong Capital, or the fund, is that we have a local presence. As much as we're all from different countries, we have a local presence right here in Nairobi, and that helps us to effectively develop and maintain relationships and networks with the relevant or the key players in the regions and the sectors that we invest in. Boots on the ground also help us to expand reach, and it also helps us to generate deal flow. So we're able to source and generate quality deal flow in the regions and sectors that we invest on. I will ask my team members to please stand up and introduce themselves. If we can please have a roaming mic. We'll start with Mr. Philip Dyke. Philip is the managing and founding partner of Everstrong Capital. If he could please introduce himself.
Thank you so much, Pumla, and it's a pleasure to be here this morning. My name is Philip Dyke. I've been involved in financing infrastructure my whole career, more than 30 years, investing in energy, transport, communications, social infrastructure in the United States, Western Europe, and then starting in 2015 with the formation of Everstrong here in Nairobi, focused in not only Kenya and East Africa, but ultimately, as Pumla was saying, next year we'll relaunch a Pan-Africa fund, which will invest in other parts of Africa as well. It's a pleasure to be here. This reminds me of the first time I met, even before KEPFIC was KEPFIC. And it was, I think it was a lunch meeting, and I can't remember which hotel it was at, but it was an opportunity for some of you are probably in this room, to discuss how to bring investment opportunities that are often structured for foreign investors into a fund where you can participate directly and obtain the benefits of these well-structured, very predictable long-term assets. Happy to do that. You'll hear more about that, hear more about our team here today, as well as our initial investment going forward. Thanks so much.
Thank you, Phil. Next will be Henry Kyanda. Henry Kyanda is the Managing Director of Everstrong Fund.
Thank you, Pumla. Good morning, everyone. It's indeed a pleasure to be here today representing Everstrong Capital. I'm happy to see old friends because I've been in the industry for more than 20 years. Happy to see you, Elijah, Ruth, and many others that we've been in this industry with. I started my career as an investment manager with Corp Trust more than 20 years ago, then moved into pension fund management, where I worked with the Kenya Power Pension Fund for close to 16 years, where I was a CEO for 11. We did quite a number of investments in the alternative space. We did property, we did private equity, we did infrastructure. Also worked as an administrator. I've worked also in banking. So I understand, and I've been a trustee many years. So it's a pleasure, and happy to be here, and we'll speak more about what we're doing. Thank you very much.
Thank you, Henry. Next on the organogram, we have Mandla Sibanda. Mandla Sibanda is our independent IC member. He is based in South Africa, spends his time between South Africa and the US. Mandla brings in a wealth of experience in corporate finance in Africa and abroad. We also have Fahima Zain as part of our independent IC member. Fahima brings over 25 years experience in investment management. Her last position was as CEO of one of the largest asset managers in the region, and she was instrumental in growing that business. Next on the slide, we have John Maingi, who is present with us today.
Thank you, Pumla. Good morning to everyone. My name is John Maingi. I'll be very brief because I'll be giving a presentation on some of the things we do in the investments team. I am the investment principal at Everstrong Capital, background in project finance. I was a project finance banker for many years, having my last stint as the head of project finance for East Africa for Standard Bank. It's a pleasure to meet you all. I look forward to interacting with you during the sessions.
Thank you so much, John. Next on the screen, we have Geraldine Mihalik. Geraldine is based in our US office. She is part of our senior advisory team. Geraldine brings in over 30 years of experience in asset management, compliance operations, and hedge funds in the US. To introduce myself, my name is Pumla, Mathe, Investor Relations, Finance and Professional Services background. We have Nima Kamau. Nima is a Kenyan but based in the US. She formed part of Everstrong as an intern in 2018, and she returned as an associate. She's currently on sabbatical, completing her postgraduate studies. And then we also have Patricia Wachira, who is our investment analyst, who's present with us today.
Hello everyone, my name is Patricia Wachira. I'm an investment analyst at Everstrong Capital. My background is in investments and in finance, mostly in alternative investments, that is real estate, private equity, and now infrastructure. Now, happy to meet you all and hope to interact with you through the program.
Thank you so much, Patricia. Thank you. And next we have Lori Roberts. Lori is based on our US office. She is our compliance advisor. She brings an experience in securities and compliance, and as a US firm, we need to ensure that we have a regulatory and risk management function, which she gets. Next we have Carol Njuguna, who is present with us today. Carol is our finance and admin manager. Carol, please introduce yourself.
Good morning, everyone. My name is Carol Njuguna, as Pumla has mentioned. I head the finance and administration role at Everstrong Capital. My background is in accounting, audits, many years handling audit assignment, both international and local, for local audit firms, as well as tax advisory. Happy to meet you all, and I hope to interact with you during the session. Thank you.
Thank you so much, Carol. And finally, last but certainly not least, we have Ambassador Makata, who has joined Everstrong as the Senior Advisor.
Well, good morning, everyone. I'm happy to be here again with KEPFIC. As how long ago was that? 2020. It was 2 years ago. So I'm happy to be back now in a different role. As you know, I stepped down 20th of January with the previous U.S. administration. Went back and saw my grandchildren for 6 weeks, and then came back here and took this position with Everstrong. And I've been enjoying it ever since. But there was a couple slides up here, not just the one with KEPFIC, but then there was 3 PPPs on the screen, and there was one in the middle where you saw the Bechtel and then Nairobi Mombasa Expressway. And Everstrong is the one putting together the consortium to actually build that road and finance that road as a toll road, as a PPP, and we're in the process of that right now. And that's one of our special accounts that Everstrong has, and that's one that I'm leading. And that's just one example of how Kenya can invest in itself in these iconic, type projects. They can act, Kenya should really be flipping the switch on in the morning and using power that they own, and driving on roads that they own. And so that's what my role is here with Everstrong, and we're just happy that you're taking a look at being involved with us. Okay.
Thank you, Karuri. So this is the team dedicated to the fund. Just basically demonstrates the wealth of experience that we bring. We bring over $3 billion across 35 infrastructural private equity investments in sub-Saharan Africa, and over $130 million over 6 infrastructure private equity investments in Kenya. My last slide basically talks about impact. We're not an impact fund, but impact is an important element when we are considering investments. It's well documented that efficient, reliable, and sustainable infrastructure is the backbone of any well-functioning society or economy, due to its positive social and economic benefits. That is why our investments are underpinned by these following characteristics: support economic growth, foster social inclusivity, as well as to invest in an environmentally responsible investments. One example we can make is the Gulf Power Plant. We've hosted most of the year at the Gulf Power Plant, which is in Athi River. That power plant basically ensures grid security as well as grid stability to the energy sector. It not only provides employment opportunities, but it also supplies thousands of homes and businesses with electricity. We also have one of our investments which fall under the fund, which is our Steel Towers investments, and we do have the Steel Towers team who will be talking a lot about, or in detail about that investment. but the pandemic has highlighted that ICT infrastructure is a principal driver of education, as well as social inclusivity, as well as social change. Our investment in the Seal Towers investment basically ensures we have a reliable communication services to businesses and homes, thus supporting economic growth. And it not only provides employment opportunities, but it also is a reliable source of communication services. The pandemic has also stimulated the need for healthcare services. Our investment in a medical oxygen generating plant will ensure that we provide access to quality medical gas infrastructure at an affordable rate, thus improving and saving the lives of thousands of patients. So basically, all these investments have a common thread through them, and that is it is to provide a long-term positive and economic impact to the societies and regions that we invest in. We also look at investments that provide critical essential services, as well as whilst they're delivering positive financial performance for our investors. We also have an IC, who basically manage the ESG of investment practices, and we also are a UNPRI signatory as of 2019. So UNPRI is basically the United Nations Principles of Responsible Investing, which basically guides signatories such as Everstrong Capital to incorporate ESG practices along the investment value chain. We also monitor our ESG and manage risks while delivering positive financial results to our investors. I'll hand over to Henry, who will take you through the next portion of the slides. Thanks, Henry.
Thanks, Pumla. Good morning once again. I'm going to take you through the next session, which speaks about the Everstrong Kenya Infrastructure Fund. And we want to use this session more to educate the trustees, many of whom may not have had the chance to review or to understand how infrastructure funds or PE funds work. I know in the room there are fund managers who are more sophisticated and they already know some of these things. But I want to spend more time just speaking to the hearts of trustees. And as Balozi has said, it is important that we rethink as an industry how we want to own this infrastructure. He has mentioned we want to switch on the lights and know that when you're paying that money, it is going to a pension fund. When you're driving on the road, the expressway, the payments, the tolls that you're making are going to benefit Kenyans through pension funds. Because what has happened, and as Ngatia has shown, most of the infrastructure in Kenya and across Africa is owned by foreign nationals or foreign pension funds. And where are the local pension funds? The local pension funds have parked their money in bonds and Safaricom. And that is not diversified enough. And so what we are bringing as Everstrong and other alternative investment opportunities is for trustees to see that there are real opportunities with very good returns, as Ngatia has shown, that are diversified and limits the risk that you're exposed to. And so that is the intention of our discussion today. We will get into the structure, but this just shows how Everstrong is constituted and how a private equity fund would typically look like. And so at the top, and Ngatia did mention this, we have Everstrong Capital as a fund manager. So we are fund managers that have technical knowledge and capacity to be able to evaluate opportunities in infrastructure. We have experience sitting on these boards because we are an active fund manager. And so as Everstrong Capital, we manage on behalf of pension funds and other institutional capital that I've shown there. So the target investors are pension funds, the BFIs, sovereign wealth funds, and all these investors then put their money into what we are calling the fund LP. So that is the fund. So investors put or commit capital into a fund that is managed by Everstrong Capital. And so the typical structure is that this fund then goes looking for opportunities or investing in opportunities that are diversified. We have talked about, and Pumla has done a good job at that, at saying that we are going to be investing in different sectors. We'll be looking at energy as one sector. So we will invest in energy generating companies or transmission companies or companies that own oil pipelines or gas pipelines. That's one sector. We will be looking at transportation. Balozi has talked about the highway, and we have all seen the Nairobi Expressway, how quickly it has come up. And very soon we'll be generating revenues that can go into the owners. So we are going to be looking at owning roads, railways, ports, all of which are private, and these facilities, when they are used, then people pay for them. So when you use an expressway, you will pay a toll, and that toll then will come back as revenue, as shares, dividends, or as a shareholder's loan through interest. We'll also own healthcare equipment. So we are looking at owning healthcare equipment, and we will be speaking about that when we look at the deals that we are looking at to invest in. And healthcare is a key sector, even for the country. We have seen the strain that our medical facilities have had in the recent 2 years following the pandemic. And so we want to enhance the capacity, and many hospitals want to buy equipment, want to expand with their oxygen plants, but they do not have sufficient capital. And that's where a fund like ours comes in, owns partly or wholly those equipment, and then we get paid by the hospitals for the use of that equipment. So the fund, what we are calling the fund LP, is a vehicle through which we will be owning these assets. So the typical structure is that trustees commit capital. They say they're going to invest $1 million into the fund. Everstrong Capital manages that fund, looks for opportunities that we will show you. Once we assess these opportunities, then we go in and buy shares in those opportunities. A very good example is one that Ngatia has spoken to, is Lot 3 Road. We will be investing in the Lot 3 Road, but through equity. What most trustees have seen is going through a debt. But we, as the Everstrong Infrastructure Fund, will be buying shares in that road. And through those shares, then we'll be getting paid a dividend. So that is the typical structure of how Everstrong Capital, as a manager, will be managing the funds that have been contributed into the fund. Below there, we have what we are calling platform companies in the different sectors. And I don't want to dwell too much on that, but maybe just to highlight. When we are looking for opportunities as Everstrong, we are looking for opportunities that are producing revenue. So if we are getting into an investment, say healthcare, we want to buy an oxygen plant, we want it to be already running. If we are investing in the cell tower that we are going to spend a lot of time today speaking about, it is already owning assets that are producing revenue. And so we invest in companies that are already owning or have operational cash flows that can be paid to the trustees or to the pension funds immediately. But before those companies come up, because we know Africa doesn't have too much infrastructure, Ngatia has talked about the deficit. We have companies that are developing these opportunities. So when we think about the road that Balozi has talked about, we will not at this point invest in it. But during the construction, during the development, Everstrong has the capacity to invest and to prepare those investments to be ready. And once they are completed and they start giving revenue, then the Everstrong Kenya Infrastructure Fund can buy shares. So we want to de-risk by ensuring that the fund that we're talking about is only investing in ready opportunities that are generating cash flows. So these vehicles at the bottom only assist us to be able to create new opportunities that then we can invest in. But having said that, there are already opportunities that are there, but they are few. And so we will be using both our own internally generated opportunities plus those that are already in the market. So that, in a nutshell, is how we operate. And we'll be happy to spend the whole of this session speaking about how we do the investment, which is very critical, how we mitigate risks, and what really are we offering as a fund. With that overview, I think I'll just speak very quickly about the key terms of our fund. What we are doing is to raise capital. We are raising $50 million. And when we talk about raising capital, we are not asking trustees to put their money now. We are just asking the trustees, or how private equity works is that you make a commitment as a fund. And you say, we are committing to Everstrong $5 million. Then we go to another fund, they commit $5 million or $1 million or $250,000. And once we get sufficient commitments, we go and look for the opportunities. And so we do screen opportunities like we have with Seal Towers, and we'll be speaking more about that. We identified Seal Towers. We did the due diligence, we screened it, we did a financial appraisal of the deal, and made a decision through our investment committee that Pumla has talked about, and the investment committee approved. And so once that approval was given, we went back to the pension funds that had given commitments and told them, we are ready to make this investment, give us your pro rata share of the investment. And so we did that, and so the funds, or the pension funds that have already committed, gave a part of that money, and we were able to purchase the stake in Seal Towers. So we are not asking for you to put money immediately, but to commit it such that whenever we find a good enough investment opportunity, then you will be able to participate. We, as Everstrong, will also be putting our own money. We want to have skin in the game, and so there is what we call the sponsor commitment, which is at 1%. And for every shilling or every percentage that pension fund puts, we will also be putting 1% of our own money, meaning that we are invested and we have skin in the game. How private equity works is that we have what we call a term. So we have a 10-year term. Our fund will operate for 10 years. Within that 10 years, we will buy investments, manage those investments, create value within those companies, improve operations, improve the capital structure, pay dividends, and at the end of the 10-year period, we will be able to sell that investment to be able to return capital. But within this 10-year period, we'll also be making and paying dividends. We are an infrastructure fund, so we invest because of the cash flows that these opportunities present. Unlike the typical PE fund that invests to expand, for us we invest based on the future cash flows of those opportunities. So the term of our fund is 10 years, subject to what we call 2 one-year extensions. In the event that the 10-year term comes to an end in a period where perhaps there's a pandemic and you're not able to sell, we will be able to seek from trustees or from investors the opportunity to divest after 1 year. And so Pumla's talked about our investment objectives. I don't want to spend too much about that, but what we want to emphasize is that we will be diversified. We will be invested in communication assets through Seal Towers, we'll be invested in healthcare, we'll be invested in roads, we'll be invested in ports, all of which provide different return and risk matrices, and which then all overall protect the investments of our investors. Another key characteristics, and I've talked about the investment restrictions, but it is to protect the investors. We do not want to be concentrated in any one asset. We do not want to be concentrated in any one sector. And so we'll be looking at investing not more than 25% in any one asset. This is to provide you as investors with the diversification and risk mitigations that you require. Another key question that we get from investors is, what are the returns like? Our returns are quite good, and Ngatia, thank you for speaking so well about returns for private equity. Our estimated return for this fund is between 14 and 18% IRR. What IRR means is that it is the equivalent of putting your money in a particular account, earning that return, and even the interest, earning interest. So it's compounded. So when we talk about IRR, it assumes that you put money in an account, it's earning 18%. At the end of 1 year, it is your capital plus 18%, earning another 18%. So it is not just a return as we know, but it is a compounded return. And so this is in USD. And what that means is that if you get a return in US dollar and convert to Kenya shillings, because most of the liabilities of pension funds are in Kenya shillings, there's an added advantage of investing in USD because the Kenya shilling has typically depreciated in value historically. And so when we talk about a return of 18% in USD, in Kenya shilling, it is close to 22 or 23% return, which is much, much larger and greater than what you would typically find in other investments. The fee that we charge is 2%, but I would also want to say that there's something that we call carried interest, whereby we are aligned. The returns that you get as investors, the higher the return that you get, the more aligned we are, because we do share in the return. I've talked about, or it is shown there, there's what we call a preferred return. So we give 8% to investors, and anything above 8%, then we share with the investors, which means we are aligned. So when we talk about 18%, the 10% that is above 8 is what is shared between us as managers and the investors. What does this mean? It means then that we are aligned with your interest. We are not just sitting back and waiting for a return. We are aligned to ensure that you get a great return that will also result in us getting a return of our own. And so those are the key terms. I'm sure I've gone too quickly, but we'll have time to ask questions and get clarifications at the end of our session. In terms of our experience, I'll speak very quickly about one investment. And this investment is not part of the Kenya Fund. This was the original investment that Everstrong Capital made way back in 2018. And it proved the thesis that there are opportunities in Kenya. So this is a power plant. It is in Athi River, for those of us who are familiar with Mombasa Road. As you are exiting Nairobi, before you get to Green Park, on the right-hand side, there is a power plant that produces 80 megawatts of power. And this power plant continues to outperform the investment thesis. Remember at the beginning I said we invest based on the future cash flows. So this investment, or this company has a long-term PPA agreement with Kenya Power, and the tariffs are defined, the rate is defined, as long as they continue producing the power that is required. We do get a lot of questions about whether HFO or fuel oil is the way to go, but previously this was the easiest and fastest way that the country would have gotten energy. And for us, as Everstrong Capital, we invested in this fund. We evaluated the opportunity, looked at the returns, looked at the management, looked at the equipment, and determined that this plant has the capacity to produce, has the capacity to run for the 20 years PPA that they have, has the capacity to provide the dividends and the returns that this plant has projected, and this project has been better than what we projected. And so this is just to show the experience that we have, but not to say that this will be part of the Kenya Fund. Another key investment that we made, and this is part now of the Kenya Fund. In December of last year, we closed the fund, and we started now looking for investments within Kenya and Eastern Africa. And the first investment that we identified and have been working towards investment is a seal tower opportunity. We'll spend quite a good time today speaking about this investment. It's a plant that, it's a company that owns telecommunication equipment, and even those images that we are showing there are actual equipment that is owned by seal towers. So what seal towers does is that it builds towers, and the telecommunication companies, Safaricom, Airtel, Jamii, Telecom Kenya, come and mount that equipment and pay a lease payment to seal towers. So the role of seal towers is to ensure that the plant or the tower is well built, to ensure that there is power, to ensure that it is secure. And once we fulfill those requirements, then Safaricom, Airtel, Telcom, and even the ISPs are able to pay. A key item that when looking at infrastructure or private equity investment is what is a pipeline? And by pipeline is what opportunities have you seen in the market that trustees or the fund manager can invest in? Because that is what really guides investors in determining whether to be part of that fund or not. So what we'll be looking at in this pipeline is how many opportunities are we looking at in terms of investment. We've talked about the sectors: energy, ICT, transportation, and water, and infrastructure, social infrastructure. We have more than 51 companies or opportunities that we are looking at. And all these opportunities then, we will evaluate them, we'll take them through a due diligence, and then invest. And so these are the opportunities. We are not saying we're going to invest in all the opportunities that we mentioned here, where there is hydro projects, wind projects in energy. We are looking at cell towers, data networks, road annuity programs, and of course the healthcare opportunities. So there are multiple opportunities that we are looking at and will be investing in. I'll pause there and want to invite our next speaker. We'll talk about the structure. And I think the unique nature of our fund is that we are based here in Kenya. There is two vehicles. There is a Mauritian vehicle and a Kenyan vehicle. But I want our good friend and partner from Bowmans. Bowmans is a law firm that has been a great partner to us in developing this structure to be able to provide local institutional capital with the required opportunity to continue benefiting from their tax exempt status. So without further ado, I invite my good friend Kendall Evans to take us through the next session. Thank you very much.
Good morning, everybody. Pleasure to be here, and Everstrong, thank you very much for the invite. Just by way of introduction, I am a director, partner equivalent at Bowmans Kenya. Some of you may know us as Coulson Hani LLP as well. We are a full-service law firm across Africa, specifically Kenya, Tanzania, Uganda, South Africa, Zambia, we have associated firms in Nigeria and Ethiopia. I also haven't mentioned our Mauritius office, which is fully integrated into the Bowman's ecosystem. We've been working with Everstrong in South Africa, Mauritius and Kenya for, and the East Africa region for at least 5 years. The asset acquisition in Gulf Power that Henry was just taking you through, we assisted both in the back-end investment to allow Everstrong to make that investment, and also on the front end as well, so the direct investment into Gulf Power itself. And I think we're very strong partners, we're very good friends, and we're hopefully continuing to build that relationship and the trust that engenders. So what I've been asked to do is just take you briefly through the structure that we set up here to allow for both Kenyan investors and foreign investors to, in effect, invest in the fund vehicles and provide the fund with capital to then make its investments in the necessary sectors. So we have incorporated or set up 2 fund vehicles. We have a Everstrong Kenya Infrastructure Fund Mauritius, which is a limited partnership, and then we have Everstrong Kenya Infrastructure Fund LLP, which is a limited liability partnership here. It's important just to note that they are limited partners and limited liability partners because your liability is limited. So these vehicles, the Kenya LLP and the Mauritius LP, are to give investors flexibility to decide through which vehicle they make their commitment and ultimately their investment. Both of them, the LLP and the LLP, are what we call tax transparent. So any proceeds, distributions, etc., are taxed in the hands or in the pockets of the ultimate investor. As Henry was mentioning, and he did an extremely good job of just stealing my thunder and giving an overview before I managed to speak, is that because this is tax transparent and it's taxed in the hands of the investors, it does mean that you continue as pension funds to take advantage of your tax exempt status. So if there is any divestiture of any of the assets sitting below the LLP, then you can still take advantage of being CGT exempt. So in effect, what would usually happen is, I think, foreign investors will come through Mauritius for obvious reasons, and then majority of Kenyan investors, we hope, will come through the LLP. There is nothing to stop Kenyan investors, if they prefer, having sought tax advice, etc., from coming through the Mauritius vehicle. But I think the unique element of this fund structure is to give flexibility and optionality to any investors coming in. There sits between these 2 funds, or these 2 vehicles, something called a co-investment agreement. And that means that in effect, the 2 vehicles will always invest side by side, and they're contractually bound to do so. And the way the structure works is that the LLP will, in effect, always follow what the Mauritius LP does. So if the Mauritius LP is going to make an investment in some ITC investment in Kenya, then the LLP will come along side by side, pro rata to the total amount of commitments into that asset. So the LP also has the GP, which is also invested directly into the Kenya LLP. So it gives it the full nexus between the 2. And then Everstrong, the funds themselves are managed by Everstrong Capital in Mauritius through an investment management agreement. And then Everstrong Capital Limited in Kenya provides various services to Everstrong Capital, mainly advisory. And that, in a nutshell, is in effect what we have in terms of the structure. I don't know whether there's much more to add there. As I said, it's a relatively unique structure in Kenya and Mauritius because of the two vehicles that sit side by side. I know we ourselves have only put together another couple, but they are relatively nuanced. This is much more easy to follow, I think, and much more straightforward, and definitely is catering, as Everstrong have wanted to the Kenya pension funds themselves. So I think from my perspective, I don't think I've got anything to add. I want to keep it relatively short and relatively high level, and I hope you've been able to follow what I've set out. There are, I think, a number of benefits, as I've said, in terms of tax, and we've reduced tax leakage as far as possible. And I think, as I said, the way it's structured, and again, just to drill home that message, is to ensure that pension funds can take advantage of their own tax-exempt status in Kenya. Yeah, so that's me. Thank you very much for listening, and I hope that that's given you at least a broad overview of what the Everstrong Capital Kenya Infrastructure Fund looks like.
Thank you very much. We are on time, and as I said, at the end of this we'll have a Q&A, but we said we are all here to learn today, and I also want to throw a question to you so that as we go for a tea break, you'll be able to think around and come with the answers. Trustees, are you together? I have a question for you. Do you have a pen and paper? Good. In your portfolios, current portfolio, when you go to the government bonds report, you see your fund managers have purchased an infrastructure bond. It starts with IFR 1/20-something/. You've seen it somewhere. It's an infrastructure bond. So the question is, today you've had two other infrastructures, the direct infrastructure, for example, the Lot 3, and you've had the Everstrong Infra Fund. What is the difference between the three? The infrastructure bond that you see on your portfolio, the infrastructure note that we are talking about, the Lot 3, and the Everstrong Infra Fund. All of them are infrastructure. What is the difference? That is question number one. Question number two. From what Ngatia presented, because we've had these questions before, what is the role of KEPFIC compared to what the fund managers do? That will help you to create the relationship. Those are two questions for the trustees in the house. And from the infra fund presentation that Everstrong has done, I expect to be receiving some questions that will have the Everstrong Capital team answer when we come back from tea break. And at this point, I want to welcome all of you. We take at least 30 minutes. 20, let me say 20 minutes, so that you're back here by 10:45. So we take our tea as we network, and as you do research of those two questions. Karibuni sana wote. So I had an exam and I want to see the answers. Who wants to answer me? Trustees in the house. I want to see if we're together. Kuna wenye wako mpaka na revision. They have a revision group. The first trustee to actually answer the question here.
Yes, I'm Albert Ambune, a trustee member elected, Kenyatta National Hospital DB scheme. We have the question that we were given. I'll start with the third bit, where we are now. The actual difference, the question was the difference between the three. I just want to mention that the Everstrong Kenya's infrastructure, was it what the fund managers do? The actual difference between the bonds is with this of Everstrong. Number one, you wait for the opportunity. The fund, the schemes can commit funds, wait for an opportunity to come, and we get the dividends as opportunities open up. With the infrastructure bond, it's you are investing at inception. You are putting in funds so that you now create the opportunity. So the difference between the three, the third one is you are more safe, because there are people, or there's an avenue which is time thinking for you, and you expect the returns as you move on. With the bonds, they fluctuate with the market and inflation. Thank you.
Hey, Makofi, he's really tried.
Yes, I'm Dr. Thomas Gidoi from the Catholic University. What I just want to add is, and one of the biggest benefits is about the cushion against inflation, which is lacking in the government infrastructure bond. But the bond that is available from Everstrong cushions very well against infrastructure. Against inflation, a very major benefit. And also the predictability in terms of the return, the long term. I believe the Everstrong bond has a good opportunity for the funds.
Wow. Thank you very much. So for the second part of the program, we need to understand the fund pipeline, and I'll invite Patricia Wachira from Everstrong Capital, 10 minutes to take us through the pipeline, and then after that we will have John Maingi taking us through the investment process, so that now the trustees are able to actually connect the dots of how we are going forward with the investment in the infra fund. And after that, we will have a case study, which is the Seal Towers case study, which will take around 10 minutes. And then after that, as we said, as KEPFIC, for us to be here today, this is an opportunity that we've done pre-screening, and we will want you to hear from the consultant themselves on their pre-screening and analysis of the infra fund. And later in our program, we'll have the World Bank and the MiDA advisors consultants present to us their findings on the Everstrong infra fund. So Patricia, karibu sana, 10 minutes.
Right, good morning once again. As mentioned, I'm Patricia Wachira. I am part of the deal origination team. So we basically originate deals, we appraise them, and we close the deals. And one of the aspects of deal origination is that we maintain a pipeline of the opportunities which are in different stages of evaluation. But for today, I'll focus on our near-term pipeline, which is deals that we are hoping to close in the course of this year. Our first opportunity, we're calling it Project Tumaini. This is a medical equipment leasing joint venture with one of the leading equipment leasing service providers in Eastern Africa. I'll speak more in detail about that specific opportunity. Then we have Project Mamba, which is what was referred to earlier as Lot 3. So under this project, we will be part of the team that will design, will construct, operate, and maintain one of the roads under the Kenya Roads Annuity Program. So the structure is that once there is an agreement with the government that facilitates payments, periodical payments to the SPV that will undertake the project. Again, on Project Mamba, the contracts actually do secure the cash flows to investors in that they have placed mechanisms to safeguard against inflation and currency risk. So the project is well structured to ensure that investors achieve our targeted returns. The other opportunity, as you can see, is Project Daima. It's a 2 megawatt run-of-the-river hydro power project. It's in Rwanda. Another aspect that we're keen on is diversifying our investments so that we can limit our risks. So we are diversified across the East African region. We're also diversified in terms of sectoral focus. The other project is Project Nanga, which is a port. It's an operating port. It is based in Mombasa. And we have an opportunity to acquire a 10% stake in that project. And once we do the project, the proceeds will be used to upgrade and expand the port. The current operators of the port have existing contracts with their clients, assuring investors or the project owners of a guaranteed level of income. Then finally, we have ICT. This is something we're keen on. We have a regional focus in that aspect, given the vast opportunity in ICT. For instance, in Ethiopia, we see the market is now opening up opportunities for private sector to come in and operate, basically provide telecommunication services. So these are some of the opportunities that we're looking at undertaking. We also have an opportunity in Tanzania, one in Kenya, and as you're already aware, we have invested in Seal Towers. For us, ICT is a key sector. There's so much opportunity. I think COVID basically highlighted the need for maybe more expanded networks in all areas, whether in the underserved areas as well as improved bandwidth in the areas that are actually currently connected. So as you can see, we want to focus to diversify our investments across the different sectors. We also want to diversify across the Eastern African region, just to ensure that we're able to spread and to spread the risks that would be involved in investment. I think I'll highlight this opportunity. It's a joint venture. I had talked about it before. We will be partnering with a leading equipment leasing provider in East Africa. So the opportunity is basically around acquiring hospital equipment and leasing it out to hospitals and other medical service providers. And why we want to do this first is we will be able to generate stable, long-term cash flows by entering into contracts with these hospitals and medical practitioners. There are two types, basically. It could either be an operating lease, where we lease to the hospital for maybe a period of 3 to 5 years, and they're able to pay us regularly, or a finance lease, where we're actually assisting the hospital to pay for equipment, but spreading the payments over a long period of time. Then they will own the equipment thereafter. Another reason why we want to do this is because there is a high demand for modern medical equipment, both by public and by private hospitals. Health is key to any economy. But I'm sure you all know that our hospitals are really ill-equipped to provide us with the health services that we need. It is not uncommon for someone to travel from our country to come towards Nairobi just to be able to get good patient care, or to be referred to a different hospital so that they can get a CT scan, or to travel abroad so that they can get treatment for a certain condition. So there is a lot of demand in the medical equipment space. Again, COVID highlighted one of the shortages in our country in terms of medical oxygen. And this is one opportunity we also want to tap into, and I'll speak more about an opportunity in that realm. Then the other aspect is demand for alternative financing structure for medical equipment. So when we're looking at equipment, we're basically looking at equipment, say for example, in oncology, that is on cancer treatment. We're looking at postnatal care. We're looking at surgical equipment. We're looking at radiology. These are the equipments like MRIs, CT scanners, X-ray machines, and they tend to be really capital intensive. So for a hospital to keep on purchasing equipment, say for example, there's always technological advances on the equipment in terms of medical equipment. So for a hospital to keep on upgrading the equipment every time there's an upgrade, it would be a really costly affair. So what they're looking for is alternative financing structures where they can pay for equipment over a longer period of time. That way they're able to free their cash flows and use it maybe for more operational expenses. Then finally, we have the government focus on universal health coverage. This was one of the big four agenda. The government has improved its budgetary allocation towards health expenditure, which includes medical equipment, but it is not sufficient. And this is where we want to tap into. And the government has also provided opportunities to partner with private entities, specifically for provision of medical equipment, both to public hospitals and in arrangements where the government gets to pay for the equipment. So I will highlight, this is the first investment that we want to do under this medical leasing joint venture. It's a medical oxygen plant. It is located in one of the main hospitals in Nairobi. It is a duplex 300 liters per minute medical oxygen generating plants. So in terms of output, you can compare that to about 50 cylinders, which each weigh about 50 liters as well. Not weight, the volume. So that's a typical cylinder that is used to maybe transport oxygen. So this is one of the opportunities that we're looking at. It is basically a sell and lease back transaction where we will buy the asset from the current owners and lease it back to them. The current owners have contracts with, they have a contract with a medical group where they're able to supply oxygen to that host hospital as well as 5 other associated hospitals. And it's not even at its maximum output level. There is potential to service or to provide oxygen to other hospitals. The capital cost of this investment is $280,000, which is equivalent to about 32 million Kenya shillings. And we intend to lease it for a period of 5 years. And from our analysis, we will generate an internal rate of return, that is what Henry talks about, of 15% and above. That's in USD. So for us, this is a great opportunity because it can be replicated even in other hospitals. The demand for medical oxygen plants is really high, and currently the current country has about 75 plants, and they're not, and some of them are not even in operational. They are not operating well. There have also been questions about the level of purity that these plants are providing. So these plants provide 94% levels of oxygen purity, which is in line with the ISO standards for oxygen purity. So we hope that by investing this, we'll be contributing to medical and healthcare and contributing to treatment of diseases such as pneumonia, COVID-19, heart conditions, etc. Yeah, I think so. We would love to partner with you, and we hope that you would be involved in this. It is not only the returns are good, but they also do create a social impact to our society. I think I will end there, but we remain available to discuss this opportunity as well as the other near-term opportunities after the presentations. Thank you. I will hand over to John Maingi, who will take us through our investment process.
Thank you, Patricia. Good morning once again, everyone. So before I get into our actual process, I think it's very important that I remind everyone of our investment philosophy and what differentiates us as Everstrong. We are an active manager, which means that we actually go out and look for opportunities to invest in companies that are in high growth sectors and have the potential for growth and need catalytic equity in order to maximize the returns or their potential. And so what that means is through investing in the companies that we select through the process I'll be taking you through, we are able to guarantee immediate yields to our investors, as well as long-term gain through exit economics. When you make an exit or you sell the company, you make some money, and that is usually a very big event for returns to our investors. So, and also just to emphasize there, underlying our investment philosophy is the ability to diversify both from a sector perspective. I think the sectors have been mentioned that we invest in, and also from a geographical perspective. We do have a significant proportion of our fund that is dedicated towards investing in opportunities in East Africa, outside of Kenya, and that gives us a lot of leverage to be able to offer competitive returns and diversify from a risk perspective for our investors' capital. So I think as I go through the next slides, which are more technical towards our internal processes, it's also important to keep in mind that this is how we add value. This is really the nits and grits of it, and how we are able to create value for our investors such as yourselves. So getting right into it, the cycle starts from the top right side. So origination, I think we've talked about it a little bit. We have various channels through which we're able to source deals, and it's very important to mention here, as a fund, we do get a lot of opportunities for investments. A lot of deals come through our doors. However, very few of them make it through the cycle, and I will be telling you why as we go through it. Once we are through the origination stage, the deals go through a screening process. Screening process meaning that we're able to determine whether it fits our strategy and what we have promised our investors. Very important to mention there that we do have an investment committee. The investment committee is an independent investment committee made up of professionals who are able to independently check on the work that is being done by the team internally. So once we go through a screening process, a lot of deals fall off there, because once you take it to investment committee, then you probably find that probably doesn't fit your return economics or sector strategy, or it's not able to provide the kind of strategic advantage we would want to provide to our investors. We then go through a due diligence process. Due diligence is very intensive for us. As you are aware, infrastructure is a very it's a straightforward sector, but also can have a bit of complications, from the sense that we do not go directly into projects generally because of the risk that's associated into it, but rather own significant minorities or majority stakes in the companies that actually own the assets, the infrastructure assets. So we do a very thorough due diligence from both from a financial, technical, legal, and tax perspective, where we do employ external consultants to be able to basically make the checks, after which we go back to our investment committee. So we have the first pre-investment committee, then you go through a due diligence process, very thorough, takes quite a few months, and then go back to investment committee for final approval. After we've done that, we now go into the actual investment stage, which is where we are able to actually start rolling out capital into projects. I will take you through the cycle we've gone through Seal Towers. I think it will make a lot more sense once you go through that. And then we have the asset management stage. Once you've invested in an asset, it moves away from the active investments team into the asset management team. The investment team is the team that I head that basically does the origination, structuring, and execution for these transactions. And then the actual management goes into the asset management team, which is headed by Carol, who will be also coming up to speak briefly. Another very important part of this is the exit. And this figure here is quite deceiving because exit planning is something that happens from the onset. From the moment you see a deal, your screening process, your due diligence process, all the committee approvals that you get, exit is always at the back of your minds because exit is what gives you the maximization of your economics. You will get a yield during your investment cycle, but really the big event where money comes in for infrastructure projects is at the exit, and that's what drives up the IRR as well. So this really speaks to the right side of the first slide. I will not go into a lot of details, but we do have various steps which we take, starting with the term sheet, which is usually a high-level agreement with the partners in the company where you want to invest in, and then you go through our various internal processes to get to a head of terms agreement, which is basically the agreement that gives a firm commitment, and then that drives through our investment committee approvals to get to the shareholding agreements. At the bottom there of the slide, you will see that the financial appraisal process is a very critical process that we go through as an investment manager. And so it follows through all the way from your screening to when you actually sign the shareholding agreements, because a lot of these projects you find because of the technical nature, for example, projects such as Project Mamba, which is Lot 3, is quite technical. There's a heavy financing structure with various instruments from debt to quasi-debt to equity that go into the actual total investment. You will find that we tend to have the financial appraisal process going all through. And financial appraisal for us means it's an internally run process, and then we have external checks because of the critical nature. Moving on to our due diligence process, I won't take too much time on this one, but basically we go through a very thorough due diligence process because this is really where you identify the risks that need to be mitigated for the project and identify also the viability of these projects. So, just to speak briefly through it, we go through a financial appraisal process. That is basically the modeling. This establishes the financial viability, whether you can get your return, whether you can get the yield that you're looking for. Then we go through a tax due diligence, which is also very critical. This basically shows us the tax position of the company, but more importantly, establishes I think when the presentation on our structure was put up, you saw that we have various instruments, various entities, both in Kenya and Mauritius, that we're able to invest through. This tax due diligence process is carried out for every investment that we go through, and they establish and give us advice on the best methodology or the best entities to use to actually create tax efficiencies and maximize returns for investors. Then we go through a technical due diligence. As you will see, infrastructure is a very technical sector. A lot of us are financial professionals who have years of experience in infrastructure, but we are definitely not engineers in the technical aspect of it. So we do use engineers and external consultants to establish the technical viability for these projects. Then we go through a legal due diligence. This is basically putting together the legal structures that enable us to invest. Now, getting to this slide, this is really where we add value and where it's the needs and grits of how we create value in the companies that we invest in. I started by mentioning that we do invest in companies that have high growth potential, that need catalytic equity from professionals such as ourselves to be able to grow, and that is how we are able to create value and create returns for our investors. So just to quickly take you through our process, in terms of value creation, the value creation is underpinned by the 5 segments you see there. So active portfolio management, I think Carol will be coming through to speak to the asset management part of it, because that's really where it falls through. And this is basically the part of actually creating value in the company. Appointing directors, appointing the correct officials, agreeing on strategy, and agreeing on financial models and all the aspects that have to do with the statutories for continuing business and being able to actually expand the businesses that we invest in. On the risk management bit, this is a very critical part. I did speak to the due diligence process. Usually what happens is once you go through your due diligence process, then you will have findings which will then have to be implemented through a risk management mechanism. The distribution management is basically the mechanism with which the funds flow, or the dividends flow, which is what gives the return from the actual investment all the way to the limited partners who are pension funds such as yourselves. And then we have exit implementation. As I mentioned, exit planning is something that happens all through the cycle of the investment from the moment we see it. And so 24 to 18 months to the end of the life of the fund, we do start an exit implementation process, and then that ends up into your exit. So I will speak briefly on the financial modeling and appraisal. Just so basically, as I mentioned before, this is a very critical part of it. We will avail the slides to whoever would like to have a look at it, and we're also, again, I need to mention we're happy to come and make this presentation to you if you need further details on this. But this is a very critical part of our process, financial appraisal, and basically on the left is what our process looks like, and on the right is typically what you'd see when you're running a model. Now, moving to the application part of it, I think I've spoken to a lot of the theoretical part of the process that we go through internally to be able to appraise the investments that come through our doors, opportunities that come through our doors, but really this is the practical application of our methodology. So, quick background on Seal Towers. Seal Towers is a telecommunication company. They hold a Tier 2 communication license, which means that they can do everything except for rolling out a national SIM card network. But everything below that is within their jurisdiction. Currently, their main investments are in towers. Dr. Tony Monda, who's the CEO, will be coming up to speak shortly on the journey that they've taken through. I think he can articulate that better than I can. We recently acquired 70% of the equity interest in Seal Towers. What that means is that we then have majority ownership of the company, and we will be rolling out north of $5 million in equity. And the $5 million is really going into an expansion strategy that has been agreed with the current shareholders of Seal Towers, and also with the officials who have already been put in place. I will take you through the process we've gone through post-investment. So just to quickly go through the line at the bottom there, we started engagement with Seal Towers in 2020. We did take a while before we actually got into detailed negotiation due to the effects of COVID and many other extenuating factors. But then in July 2021, we actually kicked off the detailed negotiation with the shareholders. What that means is we agreed on much more committal terms of how we'll go into the investment, how we'll carry out the due diligence, how we'll go about generally putting a business together, a business expansion strategy together. In September 2021, we kicked off our due diligence, and that landed into, if you remember the cycle, that landed into our preliminary investment committee, which we went to in December 2021. Also in December 2021, after that committee, we signed the Heads of Terms Agreement, which was basically the firm commitment that Everstrong is going to invest subject to a completion of a due diligence process. In December 2021, we also had a very critical milestone step for Everstrong and for the fund. That was a fast close. I won't speak too much about that. I think it's been spoken to. And then between December 2021 and the end of January 2022, we had to complete the due diligence process. We then went to our final investment committee for approval to actually do the investment in January of 2021. which then led into the signing ceremony. I'm sure a lot of people saw it in the newspaper. This happened in February of 2022. Basically, we signed various documentation related to acquiring shareholding in the company and enabling us to roll out capital into the company. In March 2022, we began our actual implementation of the business plan, which has been agreed and we have been discussing from the point of entry to the point where we got to March 2022. Moving on to asset management, I think at this point in time I will call up Carol to speak to it, but really this is how we have been able to add value so far. And the line at the bottom there shows the activities that we'll continue to do right up until we have our exit event in 2028. I'll allow Carol to speak more to it.
Thank you, John. Hello to everyone once again. So I will quickly take you through the asset management that the Everstrong Kenya Fund process is. And really this is where the heavy lifting is, because this is where we get the value realization, and all the steps taken in this process are critical to us realizing the investor returns, as well as what Henry had spoken into earlier, that Everstrong has a foot in it, and the decisions made at this point assure us of the returns and value realization. And so for this, I'll use cell towers as an example, as this is where we really are. And so the first step when we get to asset management of this investee, we appointed a CFO in January 2022. John has said that this investment was closed sometime in February. And so even before that was closed, we had already moved in and we were looking at the human capital. And we are evaluating the workforce that was already existing in Steel Towers. So we are looking at the profiles of the staff there. We are looking at the knowledge of the staff. We are looking at the competencies. And where we saw the gaps, we addressed immediately. And that is where we appointed the CFO in January to assist us with the financial planning before the second stage of the capital deployment, which is important for us. So capital deployment started in February of 2022. And this month, we also appointed a COO who will help us, of course, help us with the operational improvements, as well as to achieve operational efficiency. And this month, as well, at the end of the month, we are looking at the start of the tower rollout and the capital deployment for tower rollout, which has already begun and will move through phased rollout until the end of 2024. And looking also at the governance structure for that entity, we were able to appoint and put together a board of directors. We appointed 3 board members, as well as the company secretary. We appointed the auditors. We have the auditors, the company secretary, as well as the legal advisors for Cell Towers. And as well as we're in the process of setting up various board committees as needed. We will have a risk management committee, an audit committee, and other committees to be set up as needed. So for between 2022 and 2024, as we roll out the towers in this company, as Engineer John will speak into, we have the continued asset management and exit planning. And so for this investment, as well as the Gulf Power investment, which Henry had mentioned earlier, we are involved with quarterly investor reporting. We want to keep all our investors up to date with what is happening with our portfolio. So we arrange quarterly investor reporting to let you know, how the asset is performing. We let you know of new developments. We will occasionally set up special reporting here and there in case we need to report of any incidences that need to be kept aware of. And so between 2028 and 2030 is when, as John has spoken into, will be doing the exit plan implementation, which will be a runoff really of what has been happening across the life cycle of this investment. Thank you so much. And so I think I will invite Engineer John to take us through the technical part.
Thank you so much. So I'm Engineer John Karuri, By way of introduction, I am an engineering consultant. I've been in this space for the last 20 years. So I participated together with Everstrong in the acquisition of cell towers. So I'll be taking very quickly about telecommunication business. So here there are some numbers that I'll touch very briefly. We have about 9,000 towers currently in the country. All right. We have a population of about 52 million Kenyans. We have about 54 million SIM cards registered, basically meaning that there are a lot of people with more than 2 SIM cards. Safaricom has the biggest share of the sites currently owned. Then we have some American towers, all right? And then we have others, and Seal Tower is one of them currently with about 20 sites or so, and looking to grow very rapidly. So this is the page I'll be using to take you very briefly about the telecommunication infrastructure business. So you can see what we have here. We have buildings and we have towers. I know all of us have seen towers. So these towers carry the signal as you call, or you need data on your mobile phone. And they are normally linked backwards to a center called a BSC, an MSC, and then to an internet. So basically that's how it is. If I'll take you quickly back to the previous page, why 9,000? Why not 100,000 or 2 billion or another number? So basically, we need a certain number of sites for us to be able to have sufficient capacity in terms of to be able to support your data, to be able, for you to be able to have internet at all times and all this kind of thing. So for Kenya, for example, we will need a total of about 30,000 towers, all right, for us to be able to get into 5G. So initially, for every network rollout, what happens is called coverage, where we are trying to cover the whole country and all that. Then the next is called capacity, where we are densifying so that people can be able to access data even when you're your business and something like this. So basically we need a lot more sites, and that speaks to the fact that investment in the space needs to continue happening. So you can imagine we have 9,000 sites that have been done for the last 20 years. You can imagine the journey. If you were to build 1,000 sites a year, you have another 15 or 20 years before you can be able to get the necessary density to cover the whole country. Basically, that is how a typical site will look like. Maybe I've not delved too much into this, but basically it's a very simple compound, all right, with a tower, which is the main infrastructure. There must be a power solution, and then some spaces for supporting the tenant equipment. For Seal Tower, for example, the design is to be able to carry at least 3 customers, because as you may have known, Seal Tower is not, as John has said, does not have the capability or the license to do the SIM cards. It's only physical infrastructure. So they will do the tower and a power source, and then the customers, who are, for example, Safaricom, Airtel, Telcom, will come and occupy the tower facility. So basically that's how a tower will look like, and I know you see this a lot as you move around. This is basically how a site will look like. We have got greenfield sites and have rooftop sites. And maybe to speak about this very briefly. So basically right now, and why Seal Tower is coming in, the network infrastructure is divided into 2. There's telco and there's tower core. So Safaricom, Airtel, Telecom, and any other network that have the license to have a SIM card is called a tower core. It's called a teleco, a telecommunication company. They have the license to be able to carry the SIM cards and the signal. Then we have got the tower core, and this is where Seal Tower comes in. So basically the tower cores will build the infrastructure, and then telco will come and do what we call the active part. All right, the active in terms of installing the antennas, installing the BTS equipment, and basically carrying the signal. There's another opportunity in the tower core infrastructure, and that is fiber. Because as you route back the network back to the PSC and MSC, there's fiber connectivity that is required. That's another space that we could look at in the future. So the relationship between the two scopes is normally through SLAs. So for example, Safaricom will sign SLAs with Seal Tower, saying that we must have power throughout, failure to which you pay us so much more. Then Safaricom, you must pay us by 5th of every month, failure to which, inside goes off, then you're responsible. So the relationship between the two organizations is by ways of SLAs. So basically this is what we have. We have no more greenfield sites. You can have the tall tower, you can see the towers, and then we have rooftops. And then we have another solution called IPS, which is normally inside the buildings. So as we go into the future, we have communities getting more sensitive to the infrastructure and how they look like. So this is a small demonstration of a lot of the sites that we've done elsewhere, where you find that all these are sites. This is an antenna, for example. This is a site. You will find this in Masai Mara and other places. This is a site. This is another site where you find the wall has got some tiles, and this is also a site. All right. So basically demonstrating a bit of the infrastructure that would happen. I think that is it. I was supposed to be very brief, John.
Thank you, Manish. I think just to finalize on this session, on speaking to Seal Towns, we have all spoken from our own internal perspective. We've heard from our consulting engineer. I think now it's very important that we hear from the horse's mouth on their experience with the investment and their horizons for how they will invest or what they're looking at from a growth perspective. It's my pleasure to invite Dr. Tony Monda, who is the CEO of Seal Towers, to speak more to that.
Okay, thank you very much. I know one or two of you from another life, and it's interesting to see in this forum. Yeah. So my name is Dr. Monda. I'm not a medical doctor. I'm an engineer. I did my doctoral studies in Japan many years ago, and I had a full mop of hair. So I was back. Yeah. So I'm the founder of Seal Towers, and I'm giving you that background because it's important. I came through academics, and I specialized in steel structures. And when I came back to the country in the early 2000s, I was engaged by various telecom contractors in kind of making their tower designs more efficient because I was a specialist in steel structures. And that's how I entered the telecom infrastructure space. And then it got busy, and then I just built into it and started one or two enterprises, the latest and hopefully to be the most successful, which is Seal Towers. So we started it, me and my colleague, and basically the model of Seal Towers, as Engineer Karuri has said, I'll just emphasize on it. What Seal Towers is doing is we are building the towers ourselves. That's very important. So when you see all these towers out there, a lot of them are built by the mobile operators. But you see, that's not their core business. Their core business is to give you airtime, make sure there's network coverage here, and basically to squeeze as much cash from you as possible through their marketing initiatives. So they're seeding off all this technical expertise and technical infrastructure development and capital expenditure to tower companies. So we started the tower company. It was very difficult to talk to the banks. They didn't really understand the model, and even if they did, they were always asking for so many things like security and stuff like that. And all we had was our intellectual capacity, technical capability, and a fantastic idea, which we really kept pushing. And Everstrong came along, quite conveniently, when we were really looking for this capital, and they understood us, and they did a lot of due diligence along the way. So we started in 2015. We started discussing with Everstrong. I think it's the next slide. Yeah, there you go. We signed our investor search, well, not really 2020 or thereabouts. We signed a head of terms in 2021, shareholders agreement in 2022. They appointed a CFO in February, and then also appointed me as CEO. So I have a job now. And there we are. So we are really in the kick-off stage. We're actually on the take-off stage. We're now on the runway, and I believe we're ready to fly. So I just have 5 more minutes. I'll be very brief. I just want to highlight the growth opportunities. The first thing we want to do is secure orders for more mobile operators. Part of the process, the 2-3 year growth process that we had, was signing up the mobile operators, okay? Because we don't work blind. We don't just go and build a tower and then go and look for a tenant. It's not like that. We go to the operator, we sign frame contracts with them. So we have frame contracts with all the mobile operators, and Safaricom is also coming on board. And then we identify where the network gaps are, where the mobile coverage, like Engineer Karuri explained, is insufficient, and then only then do we build the tower there. Okay? So we don't work blind. So we do have contracts with those mobile operators, and our growth strategy basically will be to go to them, proactively identify areas that have insufficient mobile coverage, get them to give us the service orders, which is commitments to lease that location for 10 years, and then only then do we now build the tower. Okay? So Airtel is doing fairly well. Don't quote me on that. It's not usually easy to see Airtel's results because they lump all the Kenyan results in the Africa fund, but they're doing a very big expansion. Telkom Kenya, the government just recapitalized them the other day with 1 or 2 billion shillings, together with KQ, so they're also growing quite big. Then of course Safaricom, the monster, keeps on growing and growing and growing. And then we also have Jamii Telkom, who is also our client, who has a 4G network that they're building out. So the key plank on our core strategy is basically with our existing clients, growing the business, okay? Second is increasing tenancy. Every tower can take up to 3 or 4 operators, okay? That's what I started doing, designing towers that will take 3 or 4 operators. So when you get the first operator, you earn certain revenue. Now when you get the second operator, your land rent to the landlord is the same. Your maintenance of the site essentially remains the same, but your revenue probably doubles. Now when you get to a third tenant, now you're really getting very good returns. So as we build the towers, we also go marketing them. We don't just build and then walk away, okay? But it's a more of a technical sales space. And also when we locate the towers, we try and locate the towers in a location that if we're building, say for Safaricom, then most likely Airtel would come on board. So there's more technical strategy in that rollout design that we do. In the short term, the Communications Authority also does rural rollouts. Right now we are doing a project of 23 sites. They take 0.5% of revenues of all mobile operators in Kenya, and they put it in a fund called the Universal Service Fund. Safaricom's revenue is close to 300 billion, so do 0.5%. That fund has 5 to 6 billion shillings just sitting there. And so they use that fund to subsidize companies like ours, and we build in the rural areas and lease the towers out. So we provide connectivity to underserved areas. So that's the immediate growth that we are looking at. So in terms of our growth strategy is two-pronged so far: technological diversification and regional expansion. Let me start with technological diversification. This is my last slide. There's 5G that's coming up. There was 2G, it became antiquated because 3G came, 3G became antiquated because of 4G, and now you have 5G. So the higher you go in terms of 3G and 5G, the more capacity you need. So basically you're downloading a movie in 5 seconds, whereas 4 years ago it took you 5 minutes. Whereas 6 years ago it took you an hour. And what that means is that you need more towers, because it's a ball, the ball is bigger and you're throwing, the weight is heavier, so you can only go so far a distance. So you need a tower in between, so that you have full connectivity. And then whenever a building comes up, it blocks a tower, so you need another tower somewhere. When a highway like this expressway goes up, the traffic gets congested, the network starts crashing, you have to invest in those gaps. So the 5G is a space that is coming and is going to be very, very big, because you need to penetrate buildings with that signal. And we are not looking even at towers, we are probably looking at poles on the roads and the streets connected with fiber, so that huge buildings like this and infrastructure along the way can be reconnected. So technologically, those are the kind of diversifications we are looking at under the same build and own model, okay? That we build, we take the risk, Everstrong brings the money, and then we get the revenue, okay? Indoor building solutions, if you go to Surrey Center, go to the new wing, try to make a call, the call is dropping. Why? Because the traffic has suddenly tripled. Okay, so you need small antennas inside the building. If you walk in this hotel, you'll see something that looks like a small fire extinguisher thing, an alarm. So those are internal antennas that we put in any building. Anytime you build a mall or a tall structure, or even basically any big infrastructure or factory, the networks goes down, so we need antennas in the building so that you guys can do what you're doing here and make your calls and all that. So for us, those indoor building solutions is another avenue that we're going to leverage on. ISP services. Whenever we have a tower, there's so many things we can do with our tower. We have a Tier 2 license, which we invested in even before Everstrong came on board. And that allows us to not only own towers, but also to give ISP services and provide data services. So wherever we have a tower, we're going to see what else can we generate from that tower. So we can go to the rural areas, or even the compact urban sites like Pipeline and Majengo, and just provide ISP services. So that's something else we're going to leverage on. And then the Internet of Things, moving forward, fridges will be connected to phones, to stock take. You'll have data centers that are brought closer to you. So there's all that infrastructure that we're going to leverage on. So finally, I hope I haven't passed 10 minutes. Not yet. Yeah. Finally, it's been an interesting route with Everstrong. They say it very softly, but when they do due diligence, it's in caps. It is a serious due diligence. It's quite a journey. Really being stripped naked. I mean, what do you owe? Who do you owe? Who are you? So when you see them here taking equity, trust me, there's nothing they don't know about us. And it's a very thorough process. And I think you can take comfort in that. I'm a witness. A victim, but in a good way. We are now setting up governance structures. That's another lesson. Me and my partner, we started the company. We reported to each other. And now I report to somebody. So that's an interesting experience. We are setting up the structures. You can see this. They put on board a CFO, a high-level CFO. Already we are feeling the difference. And now we're setting up the structures and basically making us quite strong so that we're able to absorb the 10, 15, $20 million and grow. So lastly, the regional expansion is the next plank, the strategy that we want to go. There's a huge project in Ethiopia. I mean, they'll need 10 to 15,000 towers in the next 3, 4, 5 years. They're doing it from scratch, so we've already started that process. I've not even mentioned Congo DRC, but we just joined the East Africa community. Then there's Uganda, of course, and then there's Tanzania. You have Airtel here, you have Airtel in Tanzania, you have Airtel in Uganda. Airtel is our client here. So those opportunities we want to leverage. We're doing for you here, we can go and do for you there. So that's how we intend to expand regionally. And I think I've covered everything, yes. Yeah, that's it. I think me, Engineer Karuri, technically covered everything else. Thank you very much.
Thank you, Dr. And so, I had Mercy call you good students. They're good students, yeah? Yes. You are good students, and we thank you very much. And right now, I know we have learned, and now we can tell who Everstrong is. We can tell what Everstrong Kenya Infrastructure Fund is all about, and the sectors that they are focused in. And we've also been told what is in the pipeline for Everstrong Kenya Fund, which we believe are good things that are coming. And we hope everyone can go back and think about it, and we want to be part of this great fund. We've also been highlighted on the fund structure, which was a well thought of structure, of course safeguarding the investors and taking into consideration the tax efficiencies. And we also have learned about the investment process and witnessed by the CEO of Steel Towers that it's a robust process and also involves and puts in a lot of controls also to safeguard your commitments as well as help us achieve your returns. We've been taken through the technicalities of modeling, which is also an important process in achieving what Everstrong Fund is all about. And we've heard about a practical example of what the Kenya Fund has been able to do. And we hope really this has enlightened everyone in this room on what the Kenya Fund is able to do and what is in the pipeline for us and what we hope to achieve. And if you have any questions, the Everstrong team is available. And we thank you so much for being so patient. You know, as Engineer John was speaking, I'm not sure how many of us now feel like we are engineers. We've just been seeing the towers, the red and white towers or the streets, but really now you get to understand what is behind that. And we invite you to ask questions and get to learn more about these opportunities that are available. So thank you so much for being so patient and for listening to us. And we hope that you have learned. Thank you so much, and everyone have a good afternoon. Thank you.
Thank you, Karen. So the same way Everstrong was very strict on you, is the same way we've been strict on them, because as a representative of pension funds, what we do, apart from deal pipeline, is also do an independent due diligence, a pre-screening of every opportunity that is presented to us, so that by the time we are calling trustees in this room, we actually 100% that we are pushing for something that has gone through the correct due diligence and pre-screening. So it's at this point that we invite our consultants from the World Bank and the MiDA advisors, for them to give an independent review on the Everstrong Infra Fund, so that you will leave this room feeling that you had the expertise. Remember 3 key things that we said as KEPFIC we do. 1 is the reason why we're here, creating awareness and knowledge. That was number 1. Number 2 is deal pipeline. We've brought Everstrong on board. And the third one is pre-screening and due diligence. And this one we're supported by our sponsors, and we'll take this opportunity to welcome Gregor. Gregor is a consultant with the World Bank. Rosalind Spencer is a MiDA Advisors MD, and we will give them an opportunity as our advisors to give their independent review. So we'll connect them, and they will introduce themselves and take around 20 minutes. Welcome, Rosalind.
Thank you so much. Can you guys hear me clearly?
Yes.
Thank you so much. And thank you for that kind introduction. If I could just say a little bit about myself. I am a managing director with MiDA. And prior to joining MiDA, I was a pension plan executive director and CIO. And I sat in the same positions that some of you in the room are sitting in today to evaluate funds as well as other sectors that brought investment projects for investment considerations. So a little bit about MiDA. MiDA is a transaction advisory firm that implements projects on behalf of USAID and the World Bank. And these projects are basically long-term projects that economic development in the local economy. It also focuses on mobilizing capital from the private sectors, such as pension funds, locally, as well as from the US in Africa. So with that said, I will ask Gregor to briefly introduce himself, and then we'll jump into the presentations.
Thank you, Rosalind. And just to let everyone know, Rosalind has stayed up till a horrible hour in the morning to do this presentation, so much appreciated for being around at 3 in the morning her time. I'm Gregor Patterson-Jones. I run a consultancy out of Edinburgh in the UK, and we advise and help institutions make investment decisions right across the world, multilateral development banks and governments, also set up funds, and I sit individually on a number of investment committees for infrastructure funds around the world, and on some of those, including the European Fund for Strategic Investments, have done over 40 fund-of-fund style investments. So investing in funds from a fund, very much like the position you're sitting in at the moment. Prior to this, I was the managing director of the UK Green Investment Bank, and prior to that, the CEO of a financial services firm. So for a large part of my professional life been sitting on the side of making these principal investment decisions, specifically in infrastructure and green infrastructure. Over to you, Rose.
Thank you, Gregor. So let's get started on our presentation. Figure out how to, excuse me for a minute. Just have to get my icons down here. Here we go. Okay, so before we start, I need to read this disclaimer. I cannot read all of it because there's some obstruction going on. How do I minimize it?
Okay. I can go through this if you like, Roz, and then hand back to you.
Can you please, because I've got obstruction on the right-hand side. So,
sure. So,
yeah.
This is to say that both MiDA advisors and the World Bank are not regulated to provide investment advice as a regulated activity to pension funds, and we sit today in the role of providing information about the markets and information about best practices. So we cannot propose to assist in making any investment decision. Those decisions are purely, from a regulatory point of view, the decisions of the fund managers to the pension funds. And for the purposes of today's exercise, this is purely informational and hoping to give you a better understanding of how institutions should make decisions around investing funds and what the best practices are in regard to those. Over to you, Rosa.
Thank you, Gregor. So on to our next slide. So as a former pension fund director and having sat on advisory boards like Gregor has and sat on investment committees as well for pension funds, I fully understand the need of pension funds to preserve and grow the assets for their participants. And so for our presentation today, we plan to share with you some of the key considerations on how we went about evaluating funds for investments. And when we talk about funds, we're talking about funds like Everstrong Fund, right? The Everstrong infrastructure fund. That's a fund. There is a slight difference when we talk about funds of funds, which would be investing through a fund that invests in other funds. But I believe in the case today, our focus is investing through funds, and that's also as opposed to investing directly into projects. So again, I'm having the same problem. By showing the full screen, I cannot see the full presentation in front of me. If I stop the video, what happens? No, it just, all right. I will go through it as best as I can. Can't see the rest of it. But anyways, there are different origination approaches to investing in long-term projects, especially if you're looking forward to the likelihood of ensuring faster deployment of your capital, good risk return, and ease of execution, right? So thoroughly understanding the fund is therefore critical before you invest. It's important to understand what the sourcing process is, what the strategy is, who's going to be responsible for implementing throughout the life of the fund, and how does that meet your expectation as an investor. There are pros and cons for investing directly into a project as well as investing with a fund. So our focus today, as I mentioned earlier, will be investing with funds and sharing some of the best practices to consider when you're selecting a fund to partner with. So these are the different types of origination approaches to investing in long-term projects. You can invest directly through the funds or through a direct investment where there's co-investment opportunities to invest alongside the fund managers. Generally, co-investments would require a larger allocation to the fund and other requirements. So there could be a high hurdle in coming in as a co-investor as opposed to investing directly into that project. Providing an exit route for the funds. This is where one fund buys out another fund, creating an exit route for one, but at the same time, an investment opportunity for the fund that's purchasing the exited fund. And then through government entities and government projects. These are major sources of investment opportunities. Buying exposures on DFI. This is a struggle actually, and my colleague Dan constantly asks this question: why are the DFIs holding on to long-term projects that they have since benefited from? They should be exiting these projects, creating opportunities for private sector to get into some of those projects. And then the syndication alongside the project finance team at banks or insurance companies, and similarly here, providing equity check to get into investment projects through finance groups at the banks. And then there's introductions through organizations like KEPFIC or direct coming in from fund managers who mentioned and would like to share that information for investment considerations. So these are different types of fund originations that you will see come across your desk. In terms of investing through funds, the one big benefit that we always highlight is diversification, right? Investing through funds allows you to diversify across multiple sectors, across multiple markets, and sometimes across continents. And so it also introduces the fund to new asset classes. You heard about the towers that Everstrong is in. They're also investing in water, in transport. These are different sectors that will be difficult for a pension fund or investor to go in and loan without a large, or deploying a large sum of money. So introduction to new asset classes, and the cost for due diligence is lower when you're working with funds as opposed to the cost when you're working with a direct investment. And generally, due diligence could be outsourced to your fund accountant, fund consultant. The sharing of risk. There's multiple layers of risk sharing. You're sharing risk across project lines, across sectors, as well as across projects that are within that fund. The full deal cycle and post-investment management requirements, you don't have to worry about that because all of those functions are outsourced to the funds who will be responsible for that. Passive direct investment opportunities, I mentioned that earlier, they are available through co-investments at lower fees. There's limited involvement from the investor into the funds because the general partners are responsible for all activities of the funds and they control the long-term commitment without you, the investor, actually stepping in. What you do expect from them is a report on how your funds are performing and any information that will impact performance. So there's reliance on the general partners to have a good team in place and to successfully implement the strategy that they discuss with you to generate a targeted return that you have been promised. Now, there are a few cons that I'd like to highlight, and some of that is the higher management fee when it comes to investing with funds. There's a higher fee and sometimes carry. You have to be concerned about what the carry fee is, and Gregor will talk a little bit about in his session. There's liquidity. If you have liquidity limitations, be mindful of that, because these are long-term investments and long periods of lock-up before you receive investment returns. So I highlighted just a little bit about investing into direct projects. So there's a lower management fee when you invest directly into projects, but the upfront due diligence costs can be very high, and it's so important to spend that money to make sure that the deals are all successful and go to closure. Targeted origination strategy needs to be implemented. The project cannot change halfway through. They must be prepared and equipped to go through it all. There is a concentration risk with investing directly into projects, especially in greenfield projects. There are risk of delays, there are risk of the projects not closing, there's execution risk, there's fund overrun, cost overrun risk with direct investments. So get clear understanding before you sign up, and fully understand what you are signing up for. Now, in some direct investment projects, some of them can be short-term, but government projects sometimes can be very long-term and go through all of those risk periods that I talk about. There's limited diversification when you're investing in direct project. It's in that project and in that project alone. It is not across different project, or sometimes across different different countries. It's usually that project, so very limited diversification. In terms of cons, there's a higher level of risk due to the multiple stages of direct projects. And I mentioned cost overruns and delays in a project as well. So fully understand what the risk associated with that project is, and the ability of that project sponsor to deliver on the management and exit of that project to get back your investment plus the returns. And be mindful of takeoff agreements. So having said that, I will stop here and turn it over to Gregor to go through the key evaluation pillars and some key targets and alignment, as well as some takeaway points. Go ahead, Gregor.
Thanks, Roz. So when you evaluate funds, there's a standard process for evaluation which goes through a number of areas. And the first thing to look at when you're looking at investing in a fund is making sure that the team has both the track record and understanding of the sector. Now, infrastructure is a very particular type of investment. It has certain legal specificities. It also has a different financial approach, and it needs a well-versed team in both project financial management, financial modeling, and investment, but also an understanding of all the different legal contracting processes and the actual legal material terms themselves. So the first thing to evaluate is the team a specialist in infrastructure investing? Have they done a lot of infrastructure investing? Do they understand the legal environment? Do they understand the financial environment? And what is the track record of both entering into investments, have investments been done in the past, but also exiting? And this is obviously on the transaction side. The second side is it's important to know that the team has the ability to manage a fund, because the disciplines of managing a fund are different from the disciplines of simply doing individual transactions. The management of a fund has a certain requirement to be able to find a number of projects, to execute transactions within a very specified timeline, and then look for exit opportunities, manage those exits again in a very specified timeline. So you want to make sure that the team has experience in managing a fund and managing that rhythm of managing a fund so that the returns can be produced on behalf of the investors. So you, of course, would look at what investments have been made, what investments have been made as part of a fund team, and then what exits have been made and what returns those exits have executed. The other important component going to the next box is fundraising traction. And the ability of the team to raise funds is an important consideration because funds don't start investing normally until they've got to a particular close of the fund. So if a fund is fundraising, you want to make sure that that close is big enough to manage the fund, and that means can the fund manager actually survive on the fees that it's generating and continue investing. And of course, who are the other investors? Does the team have relationships with other investors? Have they raised money before? Do they have a process for engaging these other investors? And are those investors likely to meet the requirements that the fund is imposing on those investors? And within the African context and with the infrastructure context, most of those investors will be development finance institutions. And most funds that are in this area have largely 80% or more of their funds that they've raised are DFIs. And those DFIs have very specified requirements, including environmental and social sustainability requirements. So it's very important to know that the team has that well under control. The third thing is looking at team cohesiveness and saying, you putting money into a fund which is going to be managed by a set of individuals who are going to have responsibility for managing those funds over a long period of time. So you need to know that that team has worked together well before. Is it adequately equipped? Are they adequately remunerated? And do they work well as a team? Are they a cohesive team? Are they likely to continue working well together? Do they have a history of working together, and can they demonstrate an ability to continue working together for this long period of time, which is over 10 years? The fourth area you'd look at is the key documentation around the fund. And this is how you do the desktop type of review. And there are standards, international standards, that the documentation of any fund generally needs to be consistent with. And those are primarily the International Limited Partners Association guidelines, which give you guidelines for all the rules and regulations and the terms that you will have your fund impose on the investors. So those terms include things like what the distribution of funds is, how funds are drawn down, how they're spent, how distributions are spent, whether the funds can borrow or not on top of the funds it's raised, what the management fees are, what the carry is. And for those who are not familiar with this sort of lingo, carry is the profit share that's shared with the fund manager after realizing returns. How that carry is calculated, when it's actually paid, because there are different ways of paying that carry on an American model or a European model. The American model usually pays out carry on an individual transaction by transaction basis. On the European model, it's pooled on a number of transactions and paid later. So you need to understand all of these things so you understand what the cash flow implications are for the fund. And then all the terms of what a fund manager can do, what the roles and responsibilities are, need to be consistent with international best practice. Then you look at actually what is the fund investing in, what is its strategy, and what's the process for investment, what's its market sector, is that market sector actually robust, is it growing, are there enough transactions of the ticket size that investment fund will invest in, are they available in the regions, how many other funds are actually investing in those same assets, is there a lot of competition for assets? And then on top of that, you'll look at how do you sell an investment, because a fund will look to invest in a transaction, and then because it has a limited holding period, it will need to exit that investment and sell it to someone else. So given the size of investment that is being made in the fund, are there buyers for that asset? So if you're looking at minority stakes or majority stakes, who's going to buy them? What is the exit? Exits could be a sale to another fund. The exit could be sale to a corporate player. The exit might be consolidation, in other words, a listing, or a consolidation of a number of different investments into a listed vehicle. And lastly, it could simply be that you hold on for that asset until maturity. So you've got to make sure that the strategy of the fund, that the lifetime of the fund is consistent with what the market is asking for and what's actually doable in the market. If you can't sell an asset and your best interests are to hold on to an asset for 25 years or its full lifetime, then that's got to be consistent with the fund strategy. If there's a lot of turnover and there's assets and there are buyers and there's options for listing, of course, then a shorter term strategy will work. Then lastly, and very, very importantly, is ESG and local impact. Even if, as a pension trustee, you don't have firm ESG requirements and you don't have requirements for impact, it's highly unlikely that you didn't. But let's say you did. You still have to focus extraordinarily detailedly in ESG and impact, because your other funders that are going to be your co-funders of that fund are going to require it. So the fund manager must have a very robust ESG strategy. They must be able to articulate that, and they must have a methodology, which is a methodology for filtering projects based on their ESG, for meeting environmental and sustainability requirements which are consistent with what DFIs want. And they must have a methodology for monitoring, and they must have a methodology for reporting that. And ideally, they should have a set of exclusion criteria for investments they definitely don't want to invest in. And they should also have a set of thresholds for types of investments which are on the borderline, so might or might not meet infrastructure requirements. And a typical example might be, let's say, an investment in gas infrastructure, which in aggregate is reducing the total emissions of a country, but on an individual basis might be a less attractive opportunity to, let's say, a solar project, which is a much larger emission reduction. You have to be very clear what those thresholds are and how that's being applied by the fund. Let's move on to the next slide. So you need to make sure that the key terms of the fund are aligned with what your strategy is as a pension fund manager. And you also need to make sure that the delegated authority that you're giving the fund manager, remember, you don't have, once you've put the money into the fund, you aren't able to affect any investment decision in that fund. And the reason for that is both legal and structural. The legal reason is that you don't want to bear any responsibility for making those investment decisions, and you want to make sure that you have the tax benefit as a limited partner. But the other structural component is that you're passing over, because you trust that investment grouping, and they have the skills and the competencies to be able to invest. So the key terms for alignment are obviously, what are the management fees and the carry? Now, in the old days, the 2 and 20 rule used to rule the roost, and every fund would go to market saying, we're going to take a 2% annual management fee on the committed capital, not the invested capital, the committed capital, for the period of the fund until the fund ends. Things have changed a little bit over the last 10 or 15 years. Funds now split up their management fee between the portion of time that they invest and the portion of time that they're holding the investment. So you'd look for a management fee which has a lower management fee once the fund is fully invested. That's the norm now in the market. You'd also look to target where the DFIs are targeting the management fee, which is in fact lower than 2%. And you're seeing now that the DFIs are very much in the 1.75 area for management fee. And on infrastructure funds in particular, especially the longer term ones, the carry has reduced from the standardized 20 carry down to 15%, and in some cases the funds even lower than that, where they're doing bigger ticket transactions. So be very sure that you make sure that the fund manager is within the benchmark market area for fees and carry, but also that they're going to meet the requirements of their other co-funders. It's no use going to market with a 2 and 20 rule and expecting DFIs to support that. Then general partner commitment is always important. Is the general partner actually financially invested in a fund? And that'll give you much more comfort in terms of whether they have a skin in the game. Now, it's important to do this knowing that that is done up front. There's more risk, obviously, if a general partner is investing by reducing their fees over time, because the incentive to carry on with the fund is not as strong as if you're investing and committing the fund up front and it's being drawn down on the exact same basis as the rest of the limited partners. The next thing you look at is seeing whether the ticket size, the total size of the fund, the total size of the investment, and the first close is consistent with the amounts that you can invest as a pension fund. Is the minimum amount something that you can meet? And is the average amount of investment actually consistent with the amount that you are going to allocate to a infrastructure investment? Then there are certain things that are sometimes done by side letter, what's called a side letter, which allows you a certain different rule from the standard rules, and you want to know what are the rules around that. If I want to have an opt-out provision, can that be done through a side letter? Is the side letter requirement means that I've got to put more in the fund to have that benefit? What are the rules around that? And it's important to know that you can meet your requirements through that. The last thing is cash flow waterfall, and this is an important point because funds invest on a committed basis. They don't draw down the funds immediately. So when you invest in a fund, you commit an amount, let's say $5 million. That $5 million is not drawn down in one go. It's a commitment to have that drawn down once the transactions are lined up. So the money comes out and is asked of you on a periodic basis when a transaction needs that money. So you don't have a very clear money in and return profile. You've got to be able to model the return profile in the financial model of the fund manager by knowing when the money is going to be drawn down and then distributions when they're going to be paid. Infrastructure investments will always have a distribution during the lifetime of the investment, and then once the investment is exited, a big bullet payment, but there will be distributions in the meantime, and you need to know, are those distributions going to be held within the fund for future investment? Are they going to be paid out? If they're held within the fund, you need to make sure that they're reinvested quickly, otherwise it drags on the returns of the fund. And then lastly, we've talked about this, the terms of the fund, are they aligned with best practice? Next slide. So, the other key considerations that you need to look at is a fund the best vehicle for you to invest in? And if you don't have the skills and competency and you want a broader risk allocation, you can look across at that. Thanks, Ross, for pushing on to the last one. It's fine, we can push to the last one. I'll talk through the last one because we're running out of time. Okay. The second thing you look at then is it consistent with the investor requirements, and is the strategy believable, and can you support the fund manager in meeting that strategy, and is it well structured, well managed, and stable? Very important. Is it stable? Then how are the individual transactions invested in? What are the thresholds, and what's the risk tolerance of the fund? Is that consistent with what your pension fund wants to see? The risk of fund in investment should, by rights, be lower because you're spreading the risk and you're putting money in the hands of a skilled sector expert. So it's very important to know that that is being well managed. Then, in order for you to evaluate a fund, you've got to do proper pre-fund investment due diligence, and those areas which I talked about, all of those areas have to have a detailed evaluation associated with them in order to make sure that you've covered absolutely everything which is needed to be looked at in terms of an evaluation of a fund. Finally, the long-term sustainability and expected return profile of the fund is something that you need to know upfront. Funds are not liquid. Private equity funds and infrastructure funds are not something, unless they're listed, that you are expected to be able to buy into and immediately sell when you want to sell. You've got to know that those funds will be sitting with the fund manager for the period of the investment period until exit. So if the investment period of a fund is 5 years and they start exiting after that, you'll have your money drawn down over that period of 5 years, but over the later period of 5 years, you might only be receiving your returns. And importantly, a lot of funds have an extra little bit of cushion in case they find it difficult to sell the asset. So a 10-year fund often has an extra 2-year optional period to extend and a following extra 2-year optional period to extend. So when a fund does that and they say we'd like to have the option to extend for an extra year or an extra 2 years, it indicates that there might be some challenges in selling, or that it might take some time to realize the best value for that investment. So when you're looking at a fund of 10 years plus 2, you need to be comfortable that you have a 14-year horizon in terms of your investment. Is that okay? Do you need liquidity before that? If you need liquidity before that, then a fund investment is not the right vehicle. I'm going to leave it there and open to answer any questions. As I said, what's important about today is to give you a flavor of how you evaluate funds, and the important point, not to point to particular funds and say that these funds are very well run or less well run, or they've got a good proposition or a less attractive proposition. That, of course, is a decision that needs to be made by the fund managers and the trustees, understanding these evaluation points. And we're here to help and answer any questions about those evaluation processes. Thank you, and thank you again to Roz as well.
Thank you, Gregor. We'll open the floor to Q&A.
Thank you so much, Rose and Gregor. And I think we're at that point of Q&A, and we can start with the latest presentation, and then other questions. Edwin, the mic can go around for questions. We can make this a bit interactive, a question and an answer, so that we clear the backlog of questions.
Thank you so much for the presenters. I have a question on the exit strategy, particularly on the real on the project, on the towers, the seal towers. I think the exit was 2028, but from the presentations on the investments in Ethiopia, in DRC, Congo, I think that would be at the peak of the investment by the time you're exiting. So I was wondering why you have to exit at that particular moment in time. Or is the exit really necessary when the business is really doing so well? That's my question.
Phil?
That's a very good question. Thank you for asking. The reason why you look at exiting at a time when a company is at a peak to a certain degree is that you're looking to create an opportunity to draw on the liquidity at that point. So a new investor, if it's a strategic investor who is looking to be in the Kenyan market, for example, they're not currently in towers business in Kenya and they want to enter it, would look to a company like Seal Towers at a more mature point, and that's one of the things that we look at. Or if it's a financial investor, they also might be looking at the possibility of taking a company that's more mature, not necessarily growing it as much as we would. I want to add another point though. If you like an investment and you want to continue it, and we're exiting from the fund, that doesn't mean that you have to exit. You might be part of the buying part. In other words, there's an opportunity for the investors who are part of this fund that like Seal Towers as an example, or one of our other assets, to participate in the structure that is an exit opportunity for the fund. But we do have in the fund an obligation to return capital, and we have an incentive to return capital as quickly as we can with as high a value back to the fund investors as possible. A good question. Thanks.
Thank you, Phil.
Again, Albert Ambune. Just to understand, maybe when we talk of investment in, there was a mention on investment in Ethiopia, in the Seal Towers, and maybe DRC, and going outside. Those DRC are supplied to be in the East African community. Ethiopia is not. Do we consider this as offshore investments, and how are we hedging over the US dollar, I mean the forex exchange fluctuations and those kind of things, so that we are not, because the dynamics, the political dynamics in around us, like just what happened in Ethiopia a few months ago, some fear of run on the government, and those towers are being put up. What hedge do we have, or what plan do we have, so that they are not becoming part of the restructure? Thank you.
Andrew, you can take that.
Thank you very much for that question, and it's something that we consider heavily when making investments. In some of the investments that are high risk, like in Ethiopia and in other jurisdictions, we do insist that the transactions or the contracts are in hard currency. Even here in Kenya, we do have deals in energy, even in the roads annuity program, that are linked to the USD. So if there is a fluctuation of the currency, then we are covered, because the structure of the payments in such a way that they are related to hard currency. So that's one way in which we hedge against the cost, the risk of inflation. In areas, so in countries that are within Eastern Africa, that is our area of focus, and so they would still be considered as regional investments. And so in all circumstances, we consider hedging. Where we only have local currency denominated contracts, Everstrong can engage in hedging activities with banks, where we take risk, or where we buy the foreign currency in advance, and have a mechanism to protect local currency versus USD. So those are the two main mechanisms in which we manage foreign exchange.
Thank you, Andrew. There is a question.
Okay, thank you so much. What is my name? Now, this is generally in regard to infrastructure board. I think it's related to Mr. Ngatia. There's a mention of the same, this is for infrastructure board being inflation linked. Now looking at the lottery that just concluded, I think that it was about 12.6 or something, which to be looked fixed. So maybe you can dwell deeper into how it translates to being inflation linked, while looking at it was a fixed interest thing, just like any other board, just for understanding.
Thank you very much for that question. In the case of Lot 3, it was a fixed bond at 12.6%. But if you think about, and that's because the underlying structure is, it essentially is a long-term loan that you're providing to the sponsor, who is also providing a long-term loan to the government. So the sponsor builds the road and is paid back over time. So in that case, there are no, it's not tolled, for example. If it was tolled, then you'd expect to see, as inflation goes up, you would expect to see also the tolls going up as well. So then you would have that inflation link we're talking about. But in this particular case, because it was just simply debt, it was just simply a long-term facility that you're providing, then in that case it's fixed. But we could very well have structured the same transaction, as a variable payment, but that would not be linked necessarily to the performance or to inflation on the road, but to inflation in general. And that's why you can have a floating rate bond, for example. So the good thing, just to reiterate about infrastructure, is that it gives you a lot of flexibility to do more than if you were just looking at a fixed rate, straight bond opportunity. And so depending on what the appetite for the market is, we look to structure the transactions that way. Part of the feedback we actually received from one of the fund managers was, if we expect interest rates to go up, shouldn't this bond be variable? Shouldn't it be floating rate? And we were able to come back and show them the example of, there was another corporate bond that was issued not too long ago, where they had both options. You could get a fixed rate, you could get a floating rate. And the fund management community, who represent all the pension schemes here, were very clear that they wanted certainty of returns. And so just as much as your returns could go up if it's variable, it could also go down. Yeah, so it's part of portfolio management. It depends on what the other components of your portfolio are. Maybe you have a lot more variable bonds. Maybe you have a lot of equity exposure, which is variable by its very nature, and you want something that's fixed. So there's no one hard and fast rule to it. But infrastructure allows you to take advantage of both the floating nature in terms of the returns being linked to inflation and otherwise.
Okay, my name is Duncan Msafiri from KNHDC scheme. I like the idea of the project Maingi. If rolled out well, it will have an impact to the society. Now, there is this animal in the house of indiscipline among ourselves. This one is both in the private sector, hospitals, and even public sector, whereby you'll find that I could be owning a private hospital and I assign an employee in a public hospital or in another hospital, which is private, to vandalize a machine so that the clients will be sent to my hospital. Now, that one, it's happening, I know it's happening. Now, how do you mitigate the risks of breakdown and also the costs of repair? Thank you.
Thank you very much for that question. I think just to answer it, and this just plays into the role which the private sector plays in provision of critical infrastructure. So what you typically find in these kinds of situations, the risk that you are speaking of vandalism and the hospital having to stomach all the costs related to repair or buying a new machine, for example, are now passed on to a private entity. So the JV that we are setting up to provide medical equipment is really transferring that risk away from the risk of raising the capital to buy the equipment, maintenance of the equipment, and the risk of handling all other maintenance issues such as the one that you mentioned are now transferred to the operator. So what you'd have is, for example, if you need an MRI machine, there would be a lease agreement and you pay a fixed payment over a contracted period of time, and then the private partner, who is ourselves, will then take the risk of any associated security risk or asset turnover risk or maintenance risk is now passed on to the private players such as ourselves. So actually, what then the value proposition we're giving to anyone who is in the health sector is taking away the risks such as the one you've spoken of with regards to security and vandalism and replacement of assets.
Thank you, John. Any other question before we close the Q&A?
Yeah, thank you for the opportunity. I think mine is on the issue of the sea towers. There was something that was presented about the camouflage telco. I would like maybe an expansion of that. I didn't really get it. It was too short. Number two, the whole idea is good on technology. That is the direction that the whole world is moving into. My only question is about the contracts that I think were presented. It was mentioned about having a contract with Jamii, Telcom, Safaricom, Airtel. Now, looking at many other players of the sort, I just needed to hear, to get this confirmation that there are these contracts that are available with these service providers. Thank you.
Yeah, on the camouflage towers, well, not to get too technical, but generally you have 3 or 4 types of towers. You want to achieve a certain height of tower, because the signal comes from the ground to an antenna, goes down by fiber to another tower, or sometimes goes through the air from a microwave link. So you have the greenfield towers, which are the red and white things that you see standing from the ground. And then you have the rooftop towers, where we take advantage of a building, so it lowers the cost, so that we don't need to build a tower from the ground, for example, on top of this building. And then now you have the camouflage towers. If you go to the leafier residences like Lavington or Karen, sometimes they don't like the towers. They're red and white, and people feel they degrade the value. I don't want to be too harsh, but they use stronger words, the neighborhood. Yeah, so sometimes you have towers that look like a palm tree. So when you look at it, it looks like a palm tree or a tree, and it's camouflage. So that's what he meant by camouflage towers. On the contracts, I didn't get your question, but what we do and what we invested in, for example, as Seal Towers before Everstrong came on board, is we already procured the contracts from the operators. So they are called frame agreements. So it's a long-term agreement, and it outlines how you go building out the sites. So when you identify a location and they agree, they give you a service order, which is a commitment for 10 years to lease that. So when you get that, then you build. So you know that for 10 years you're getting that revenue every month from that particular operator. So that operation is guided by a frame contract. And so we have frame contracts now with all the operators. Yeah, so those contracts are in place. That answers you. Thank you.
Thank you so much. I think we can close the Q&A there. I was the first person to speak, but I don't want to be the last one. So before I let Constantine Kandia come to stage to do a closing remark, I noticed I didn't introduce myself, and it's because of the assumption that everyone here knows me. But for those who don't know me, my name is Masigaki. I'm with KEPFIC, the Investor Relations and Member Outreach Manager. And I look forward to engaging with you more and more. I told some trustees, the Kenyatta Hospital, I was telling them, we are here so that you can learn. We're not putting a gun on your head for you to invest, but we want to champion for awareness in infrastructure and alternative investment space. So whenever there is a capacity building, come learn. By the end of the week, I'm sure you will have reported to your board about an opportunity you had, an opportunity that was presented to you, and that will open the discussion to the whole board. So I wish to recognize every trustee who is here. Thank you so much for honoring the visit and for actually honoring to be here, putting aside your work office just to learn. And I look forward to engaging with you further in more other capacity building, in more other events to come. And at this point now, I'll ask Constantine Kandia to come and do closing remarks and a vote of thanks. And after that, we will head for lunch at first floor, the CVR restaurant, where now we'll network and engage further. Thank you so much.
Thank you, Masi. Good afternoon, everybody. We are truly honored and privileged as KEPFIC for the time that everybody has set aside to be with us today, since breakfast to now. I think that is really something which as KEPFIC I want to say asante sana for coming and sitting with us in this meeting. I want to believe we have all learned a lot. Is that correct? It is, huh? Good. So in terms of appreciating this day, I want to perhaps quickly just summarize the presentations that have been made, and Everstrong as well. What I picked from the presentations is that it is quite important as we are making our investment decisions as trustees to invest in funds that have got stake in the investment. I remember there were times earlier on when we would have various project promoters coming to us and they had 0 to maybe 5% stake, sometimes even less, in the investments that they were asking us to invest in. I think that having a partner who is actually invested in their own investment, the question about whether it will be a success becomes almost an obvious question, because of course the promoters don't want to make losses either. So that was one of the takeaways for me. The question of having a manager who is very active. Everstrong have come to Kenya and they are based here. And I think the last I had, you even transferred your headquarters. So Kenya became a branch. I think it was a contact region, then perhaps a branch, and now it's the headquarters, because of the import of investing in Africa. I think it's also quite important, the questions that we have asked. I was really, really moved by the questions that are being asked these days in KEPFIC meetings. And I think during the break, we were conversing with some of the trustees, and what we were saying is that KEPFIC events provide us with a very safe space where we feel we can interact without feeling committed to any particular project or fund manager or even, as it were, any promoter. That is because KEPFIC is your organization as trustees. This is where you come to learn, this is where you come to ask the tough questions. I did warn Everstrong that there would be tough questions that they would need to answer, and this is what this particular forum provides. So with that, I want to thank Everstrong very much for accepting to come here to be grilled. Who was this who said they were grilled by Everstrong? Today was Everstrong's turn to come forward and be grilled and to face the trustees. Somebody in West Africa told me that in West Africa they say, you need to face your front. I find that a very interesting statement. Face your front. Come to the front here and face the music. Let all the questions that need be asked be asked. We've learned a little bit more about the technical aspect as well. But I think ultimately for all trustees, the big question is, what is the risk and what is the return? And I think those two questions have been put to you in various ways. It is very, very critical and important to us when we make these investment decisions. So Everstrong team, thank you very much for coming to this, and I pray that it has been useful for you as well. And from here, we go forward to perhaps make individual presentation to the funds, depending on their requests, more clarifications through KEPFIC Secretariat as well. They can continue to engage. This is what we provide these forums for. The second group that I would actually like to say a big thank you to are all the presenters. I know Rose, for instance, is still online, and Gregor did make a presentation but has had to exit to join another meeting. The team from Everstrong, all the varied speakers, it was really good and important to engage with each individual. Now we know, when we are sitting in this room, we know people by name, and also we know them by face, and we can also meet them tomorrow and say, we met yesterday, could I ask you, a further question? So I'd like to encourage that kind of interaction as well as go to lunch. I really, really want to thank Ngatia. Ngatia is our boss at KEPFIC. Thank you very much, Ngatia, for continuously engaging with the sector, coming back to us with your learnings, and even guiding us as trustees as to our role, what are the guidelines, how should we engage with fund managers, how do we smoothen relations across the sector, engaging with the regulators, with government. So for you and your team, and I want your team to stand, Mathe is the team. Yeah. I mean, we really do appreciate the time and the effort that you put in, all the work you do in the background to make us look very good, but more importantly, the tough questions that you have to answer every time you go out to try and explain what is the role of KEPFIC. And today I was very excited that you asked the people to tell you what is your role, so that you can, be responsive to them as well. So thank you so very much. I want to also ask my colleague, Elena, who is on the steering committee of KEPFIC together with me. Is there anyone else, or it's just you and I? So Elena, please, I'd like to introduce you as well as a part of the steerco. And by the way, so Elena is with Kenya Pipeline Corporation, and I could say they were the very first to pay up membership, right? And right now we have so many more members who have paid up. Thank you, Ngatia, thank you, Mercy. Let us all be together. I want to bring your greetings as well, and apologies from the chair. He was confirmed to come, but the last minute something came up, but he's definitely with us. And I know there are a few other people that I need to thank who have joined us virtually as well. As well, I'd like to thank the World Bank, I'd like to thank USAID, I'd like to thank MiDA, because they have continued to hold our hand as a consortium. And as you have heard, Kenya is now leading the way in educating other consortiums on how they should come together. That's not to say we have solved all our issues, it is to say we've started the journey, and we would really like to have feedback. You heard Ngatia earlier on say that we really were instrumental in enabling the introduction of the infrastructure asset class. That is because of input from yourselves. We need to continue that engagement. Where you find there's a bottleneck, where you find there's a challenge, please come and let's discuss together at the table. So when you're seated at the table, you are KEPFIC. Don't look at KEPFIC as an organization for some guys over there. This is your organization. So when you sit here, you are at home and you are here in your right. Ambassador, thank you very much. He really does the hard work. You should see him at work. He really is on the ground, and it's quite impressive to see you with that new hat. When we were discussing the opportunity to have this forum, I think he really grilled us as well. And here we are. So we thank you very much. Phil, asante sana, together with your team. As we wrap up, please, I would like to encourage that you sit on a different table than you are sitting today. At the meeting, at lunch, interact with a different group, and let's get all the learnings in there. Make a follow-up with the KEPFIC Secretariat to understand how to engage with Everstrong, how to take these meetings back to the board for further conversations. And I would like us to meet here next year when we have made more investments and we talk about what we've now, what our earnings are. Asante sana everybody, and wish you a lovely rest of the day. Karibu sana.
Thank you so much, Constantine, for putting this point. My name is Winnie Chepto. I'm from USAID's Kenya Investment Mechanism. I'm a communications assistant. Okay, you shall pray for lunch. Thank you, God, for this opportunity that you've given us to interact and to hear about KEPFIC, and for everyone to be together. And thank you for the success of this meeting. We pray that as we're going to have lunch, that you may bless it and you may bless everyone. In Jesus' name we pray and believe. Amen.